you guys are just joining, my name is Whitney Elkins-Hutton. I am the Director of Investor Education here at PassiveInvesting.com. And I'm so excited. This is our second Passive Investing Made Simple Bootcamp. And this bootcamp is going to be focused on more advanced strategies. And when I say advanced strategies, I mean all those different questions that you have probably rolling around in your mind around legal, like how do I get my, everything set up legally, like my legal structure when I invest passively? What kind of questions do I need to consider around taxes? Is there a best way for me to utilize my retirement funds to invest? And for those savvy investors out here, how can I leverage the money in my whole life insurance policies, or even set one up specifically to invest and supercharge my wealth build? Guys, we're going to be able to get the answers to all these questions tonight. Now, again, like I said, we've got a few minutes before our first guest joins us live, Norman Prate. And I would like you guys to do two things, okay? One, if you have a question, jump over into, find your Q&A button. Okay, now the Q&A button is going to help me stay very organized as I moderate the different sessions tonight. So it's very important. Chat, things tend to scroll and get lost. There's a lot of comments. So since we have so many people on tonight that are probably going to be interacting and wanting to get questions answered live, make sure to go over to that Q&A box. Now, and if you don't know where it is, raise your hand. We'll make sure that you get oriented to that. All right. So, and guys, people are still rolling in. This is fantastic. Okay, you guys haven't missed anything yet. We're just going through a little bit of high-level introduction. Now, the second thing that I want to ask you to do is to join me in answering a few questions. Here, I want you to go to the chat box. And in that chat box, I want you to start populating the different questions that you have that you want to get answered tonight. So the first question I have for you is, what is the top thing that you would like to get out of tonight? As we talk to our legal experts, our tax experts, our SDIRA experts, and our insurance experts, go to the chat box, and I want you to start dumping these things in there so I can actually help curate the conversation to your needs. All right, I'll go ahead and take a minute and do that now. There's a couple questions already coming into the Q&A box. I love it. So yes, tonight's session is being recorded. If you are live here at the end of the session or live in the session, you're going to get the recording. If your friend did not attend live, they're going to have to register in order to get the recording. So I want to make sure this information gets spread as far and wide as possible. If any of you guys have ever met me before, I'm very passionate about real estate in general, but definitely in passive investing in building wealth. So yes, it'll be recorded. You will get an email with that. Give us a couple days because this is a long video to render. And we'll have to do just a little bit of editing to it as well. All right. Let's see here. If you guys are just joining in, before our first guest comes on, I just asked the question to everybody here: what is the top thing that you want to get out of tonight? The top burning question, or two or three, that you want to get answered from our experts, because this is going to help me curate the conversation to your needs. All right, let's see here. What is their number one recommendation? Okay, Benny, would love to know more recommendation on what. What to do, what to avoid. Yeah, be specific, guys. Be really specific in your questions because that'll help me make sure that I get the answer that you are looking for. Could we actually see an example of lazy 1031 with numbers? Ooh, yeah, maybe we can talk to Amanda Hahn about that in our second session. What's the most common investment type of properties? Ooh, so I'm not sure, Amy, I'm not sure we're going to actually get to the bottom of that question, but I can tell you what we invest in here at PassiveInvesting.com. We do multifamily, self-storage, car washes, hotels, as far as equity investments, and then we also have a real estate debt fund. So if you want more information about what we're doing here at PassiveInvesting.com, definitely hit me up at passiveinvestingwithwhitney.com, and you can, schedule time with me, and I'd be happy to go into that very deeply with you. Benny asked, do I have an agenda? I mean, I do. So our first presenter tonight is going to be our legal expert, Norman Prate. Our second speaker tonight is going to be our tax experts, Amanda Hahn and Matt McFarland with Keystone CPA. Our third speaker of the night is going to be Scott Maurer with Advanta IRA. And our fourth speaker tonight is going to be Chris Larson with Next Level Income, and Blake, I'm blanking on his last name, Morris, I believe, with Money Insights. So yeah, that's kind of the overarching agenda. As far as like ground rules, there's only two. Okay, number one, participate. If you got a question, specific question for me that you want me to ask an expert, go to the Q&A box so I can stay organized. If I'm asking a general question to the group and want engagement, go to the chat box. Those are the only two ground rules. Other than that, we're good. Now, guys, again, I'm just making sure that everybody is getting in here and settled before our first person joins us live. Again, the question that I asked the group, that I asked you guys to go to the chat box for, was out of our legal tax, SDIRA, and insurance experts that are going to be here tonight, what is the top question that you want to get answered from them? Okay. All right. You guys just go ahead and take a couple more minutes, get relaxed. All right. Oh, and all right, and Norman is already here. Yay, Mr. Prate.
Hi, how are you doing today, Whitney?
Good, how are you?
I'm doing well, Just getting ready to get the PowerPoint up to share the screen. Are you ready for me to get started?
Are you guys ready for Norman to get started and talk about all things legal in regards to passive investing? I believe we are. Go ahead and take it away.
Sounds good. Is my screen sharing now for y'all?
Yes. We can't see your video, but we can see your screen.
Alrighty, I'll get the video on as well. Sorry, Zoom is spinning as I'm trying to activate. There we go.
Excellent. We can see you now. Thank you.
Alrighty, sounds good. I never know during these webinars whether I'm actually on screen or whether it's just going to be the PowerPoint. Alrighty, well, I want to thank everybody who's attending today. I'm Norm Prate with Brownlee, Whitlow, and Prate. We're a law firm in the Southeast, North Carolina, South Carolina, and Georgia, and we work on transactional matters such as more multifamily than anything else, but a lot of other types of commercial investments as well. Car washes, gas stations, office buildings, self-storage facilities, hotels. I'm also general counsel to the North Carolina Apartment Association, and we work directly on property management issues as well. We've worked in securities issues, and I'm here to speak to you about legal considerations in building your passive investment portfolio. First thing, disclaimer, this isn't legal advice. Our carrier makes us put that on all of our presentations, so it shouldn't be relied on as such. Moving in, biggest and first consideration when you're looking at a passive investment is, one, can I afford to be without this money for the next several years and possibly forever? It's an investment. Most of the time, the paperwork will say for you, your private placement memorandum and things will tell you very clearly that the investment is illiquid, meaning that you can't get your money back right away. You can't get it back immediately when you want it to. Generally, often it'll only go back to you at the point the property that you've invested in is sold. So it's many times it's 2, 3, 5 year period. So this shouldn't be money that you need to survive on a daily basis. If you're in that situation, you probably don't want to be putting money into a passive investment. There are additional initial considerations. Are there other investments that meet my goals but allow more flexibility in retrieving the funds if I need them earlier? This is kind of part of the same thing. Am I ready to be without that money for a number of years? That's not to discourage anybody, because this passive investing is often a great way to go, and we've seen some great returns over the years on it. But just so you are aware. Then next question, what will I be risking? Will I be liable for any additional capital contributions? Many of the investments, it's just a matter of what you put in as your contribution. Occasionally, some are structured, so if they need more money, that they can go back to the investors and take additional contributions. But largely, you're just risking what you've put in as your investment. And the last and another very big question: are you comfortable handling almost complete control of your funds to the sponsor? The passive investors don't. Occasionally, there's matters they vote on. Often, there's not. They don't have a whole lot of input. They get to take a look at how the investment's doing, but they don't make the decisions. That's where the passive part of passive investing comes. You'll have hopefully experts doing that for you. Going further, prior considerations, the asset to be purchased. Am I sufficiently familiar with this asset class so I can evaluate the investment? Or if I'm not, do I have professionals that I'm working with that can help me evaluate the investment, such as your CPA, attorney, other sort of real estate professionals that you're working with? Am I familiar with the geographic area? So that you can evaluate the investment? And who will manage the asset after purchase? Am I familiar with who will be running the show? If it's an apartment community, often the sponsor will act as sort of an asset manager, but they'll retain a separate property manager. And there's often legal requirements in the various states as to who the property managers can and can't be. It's usual certainly in a residential context and in many property management contexts that the property manager has to be licensed with the state real estate commission in some way. And we've talked about the sponsor a little bit. Am I comfortable with the sponsor? And just to take a step back, I've used that term a few times. If there's anybody who's very new on this, the sponsor is essentially the person or group that's putting together the investment. They're vetting it, they're running the numbers, they're putting everybody, they're taking in the passive investors. They're basically running the whole show. They're finding the lender, so the debt portion, the investors, the equity portion, the property, who's going to run the property, what legal team's going to be involved on their side, what tax team, all those things. So you want to make sure you're comfortable with the sponsor. Things to look at: how experienced are they in real estate investing generally? Do they have a track record that you can look at? How experienced are they in this type of asset or this class of asset? Are they familiar? Do you feel comfortable putting your money up with them and that they have a track record or a good understanding of the asset, or at least that their team does? Again, what is the track record of the sponsor's investments? Have they met their projected goals? When you're looking at a private placement memorandum, there's going to be projections in there often as to what the sponsor hopes to achieve, and how often have they met those goals. Another question is this: does the sponsor have skin in the game? Are they investing as well? Sometimes the sponsors are just putting in their sort of sweat equity into the deal, but often they're not. Often there's a cash out investment also alongside with the passive investors. Then going further on the sponsor, how will the sponsor receive a return? Generally, the sponsor will receive a fee on the initial investment. At the purchase of the property, they'll be paid out because of all the work that they've had to do to put it together. Those fees can vary wildly. Is there an asset management fee? As I mentioned earlier, a lot of times the sponsor will act sort of as an asset manager if they themselves and kind of overseeing the property while it's managed by some other property management entity. Sometimes there'll be a separate asset manager as well if they're, say it's a fund that's been put together and it owns a whole bunch of properties. Often it makes sense to hire an asset manager as well as a property manager. And for anybody who doesn't know, often the difference between the property manager and the asset manager is a property manager is sort of ground level. They're there dealing with the day-to-day issues and trying to meet certain projections, and they'll work with the asset manager in putting together budgets and projections and what they're trying to do. But the asset manager is more of a spreadsheet looking at the higher level numbers and higher level management of the property, where the property manager deals on the day-to-day and will be working with the tenants if there's some form of tenant or resident involved and dealing with the day-to-day issues. Is there a fee at the sale or refinance the property? Often in addition to the percentage ownership the asset manager, or sorry, the sponsor has, they'll get a fee at the sale as well. And those fees vary greatly. Sometimes if they reach a certain level of returns, they get rewarded. If they exceed the expected levels, there's a whole different structure to that. And also often if there's a refinance, there may be a fee as well. Many of these properties aren't held long enough to refinance the loan. Certainly in the past few years, rates have been low enough that not too many people want to refinance just to change the rate, and they've been appreciating so much that the properties sell very quickly. But times aren't always like that, and sometimes the properties are held for longer, and sometimes the rates will go down. Rates have been creeping up little by little as time goes on in the past 6-9 months, year. So there may be properties that will be refinanced. Often the sponsor will receive some sort of fee along with the refinance. Refinance of commercial properties is often very involved. It's a lot more complex than refinancing a home, which many people have experience with. It's almost going through a whole purchase process again, other than that you own it. But the lender portion of the purchase process is often the most time-consuming and demanding process. And it's very similar in a refinance, especially if you go with a different lender. Will there be significant work on the property which the sponsor will receive a management fee? Sometimes there's major renovations done, and that takes a whole lot of extra time from a property manager, from a sponsor or asset manager. So often built into that, if they're going to be doing major renovations to the property, there may be an additional fee for that. So these are just some common fees that the sponsor will receive for the work that they're putting in. After purchase, what information will I receive and how often? What financial and progress reports will I receive? You want a good feeling. Hopefully the sponsor can give you some sort of sample if you're curious about that, of how they generally structure progress or financial reports. How often does the sponsor have a sample? How often will I receive the reporting? Will it be on a monthly or quarterly basis, or a shorter or longer period? And do I have a point of contact to reach out to for questions? Do I feel comfortable that with the sponsor that I'm going to be heard and responded to on a timely basis? So that is these financial reports are usually your lifeline to the property and knowing what's going on. Sometimes they might have, beyond just the financials, a sort of narrative that goes along with it, especially if any major changes are going to be done to the property. If it's a sort of major value add where they're doing a lot of construction, or they're trying to, once you turn a portion of the property, rebuild it or renovate it so you can raise the rents, how is that progress going? These are the type of reports you'll be interested in depending on the type of property. Now, one of the bigger questions you'll be interested in is how will you receive a return as the passive investor? When are distributions expected to start and how often will they be paid? If it's an income producing property, often after a fairly short period, maybe 1 quarter, maybe a few months after, maybe the month after purchase, the sponsor will be dispersing proceeds to the investors. Sometimes if it's a development project where no money's coming in and you're building a new community or something like that, there's no money coming in, it's just going out to pay for the build of the property and everything. So it might have a longer window before you actually start to receive any cash back. Will all or a portion of the returns be preferred? Your finance and tax guys will probably get more into these aspects, but a preferred return, often a passive investor will receive a portion of the disbursement before, up to a percentage before the sponsor receives anything. That's not always the case, but it's occasionally the case. And will the preferred return be cumulative? So you may not hit that percentage in return every quarter. Say you're getting a 3% return on your funds and that's what's expected, or 1% or whatever the number is. If they don't hit that in 1 quarter, say you have a 7% expected return, but you only hit 4, does that 3% balance carry over to the next quarter, or does it just start again at a 7%, or does it become a 10% the next quarter? When will my initial investment be repaid? Very often the answer is when the asset sells, but sometimes there's a structure where a portion of the contributions are paid back during. If certain thresholds are reached, can I be bought out? If the sponsor can give me a return of 7%, 8%, 5%, 10% year over year, do they have the ability just to buy me out, return my initial investment plus my return, and then I'll be done with this particular investment, or am I there until the end of the investment? And when can I expect to receive a final return? What is the projected timeline for selling the asset or realizing a full return on the asset? Is it 1 year, 2 years, 3 years, 5 years, 10 years? Again, these are all projections. Nobody has a crystal ball that I'm aware of, but these are based on the sponsor's experiences. I'm gonna slow down for a second and take a look at the chat and Q&A and see if any of these are directed at the presentation right now.
No, actually not right now. I think there's 2 questions that come in. One was on the fees, and then the other one was what about the catch up in the PPM? So maybe like when you get to that part, if you could field how the catch up works, what it is and how it works.
Do they mean a catch up in terms of if they're a preferred return, or?
Yeah, so there could be, great question. As always, great guys, it's great if you are really specific with your questions, but to me as an investor, if I were thinking of a catch up, like I would think of it as far as the preferred return. And then also sometimes you see in a PPM that a GP gets caught up before capital gets distributed. So maybe we can talk about both of those in the Q&A.
Sounds good. And I guess in today's market, do refinances still make sense? Touched on that a little bit, but it really varies. It'll depend on the asset. It'll depend on what you purchased it at. And it'll depend on when you purchased it. If you purchased it a year and a half ago, probably refinance doesn't make sense unless you're required to do so. If you are purchasing something now, it's possible over the next few years rates could go lower again, and refinance will make more sense. How will the ownership be structured? Often lenders will require an ownership entity for the investment as a top tier. And then there's often a second entity below it that the only thing that entity does is own 100% of the first entity, And this is their way of insulating the assets and protecting the lender's investment in the asset. And often that second entity is is where the investors are sitting. Also, many times these days, you'll have tenant in common investments. Well, and there may be several below that own 100% of that entity, or there might be another layer down. We see many layers these days. Tenant in common investments are often used, and lenders are more and more comfortable with them because somebody's coming in with money from a 1031 exchange. That's a vehicle where you can defer taxes to some later date if they're invested fairly quickly into a different asset. They'll be held. You don't take your money after you sell whatever your prior investment is. It goes to a qualified intermediary. That person holds it. You've got a period where you can identify certain new assets you might be looking at, and then a longer period, I believe it's about 180 days, where you can actually purchase the next asset, and you've got to redeploy that capital to avoid taxing. And you can continue to do that as long as 1031s are still a thing. The government rattles there's sabers from time to time, and there's always talk about, will they continue with this year? Will they phase them out? And so far they haven't phased them out. They keep money invested, involved, and keep people improving properties and investing in properties. So it really is a great way to keep money involved in the real estate investments and to keep moving there, rather than people just take it and putting it in a bank, bonds, or a mattress or something like that. So it keeps the money involved in the investment. But when you come in with 1031 money, you've got to stay in the same sort of manner that you were before. You can't just invest into another LLC that owns a property. You have to have some separateness. So you invest as a tenant in common, and you'll be given the same percentage you would as if you were a member of the passive investing group, and be managed essentially the same way. There's a series of rules about how all that works, and there'll be a tenant in common agreement that'll be filed and reviewed by the lender, and it'll be recorded to keep the IRS happy and keep your tax deferred, so you don't get sideways on that. But it won't feel that different once you're involved in the investment. It's just the structure of getting there. Then another question is, how many classes or shares of shares or membership interests are there? Often the sponsor has one share at one class. The passive investors might have a different class. Sometimes there's a third class where, if some of those passive investors may be guarantors also, they might have a slightly different class of membership interest. And those different classes have different purchase prices and different possible preferred returns and things like that. What percentage of this ownership will the sponsor own, just relative to the passive investors? And another question is, where will the entities be formed? Shouldn't make a whole lot of difference to you. Many of the lenders require, especially for the larger investments, that the entities be formed in Delaware. That's just sort of the go-to state. The lenders like to see it because there's a established set of rules and laws surrounding limited liability companies where most of these investments are held in. It's sort of the default and go-to. So the ownership entity may be formed there and then have to register within whatever state the asset's in. On some investments that aren't as large, the lender might not be as picky as to where the investment is, or where the entity holding the property is formed, or you may have different entities. As I said, the organizational structure can be fairly complex depending on the size of the investment, and you might have some formed in the state where the property is, and certain of the entities formed in Delaware. what documents should I and my advisors review? First, the biggest one, the private placement memorandum. That's usually a fairly lengthy document that will talk all about the investment itself. It'll talk about projections. It'll introduce your sponsor to you and certain key players in the sponsor who are involved there. It might tell you who your property manager is going to be and give you some information on them. It'll talk all about the investment and often the area around the investment if the investment you're making is for a specific asset. There's sometimes you invest in a fund and it won't, so they might not know all the assets specifically that fund is investing in at the time. But it might be on an asset, it might be on an asset class, it might be self-storage facilities, and just talk about their investment strategy, what they're looking for, what types of returns they're interested in for this. So it might be a little bit more general depending on how that's going. So it could go either way, and there's nothing, one way isn't necessarily better or worse. It's just your level of comfort as a passive investor and your level of comfort with the sponsor. As it says, the slide points out, your CPA/tax professional/attorneys can help you with this as well. Often within the private placement memorandum, the operating agreement, that's sort of the structure for your ownership of the entity and how the entity is going to be run, that all the investors are in, and that holds the main ownership of the investment. That'll be sort of excerpted in the private placement memorandum. The highlights will usually be in there and that's a place where you would find what rights do I have as a passive investor? Is there anything that I vote on or not? What could trigger a sale of the property, various things like that. Also, the operating agreements may very well be attached to the private placement memorandum as an exhibit to it, as well as being excerpted in it. Any other deal specific documents that you receive. Are there anything there might be a deal prospectus, there might be other forms that have come through the realtors that are being shared with the investors as well. So just taking a close look at all those things and all the topics that we've been talking about so far. How are we doing on questions? Looks like
yeah, we have a lot of questions. Feel free, like we can, they're kind of all over the place. So we can, when we get to the part to open it for Q&A, I'll just start moderating and firing them off at you. Sound good?
Sounds good. Sounds good. Okay, then we've touched on this a little bit. On what matters will I have inputs? It's important to know when you have inputs, usually through a vote on any matters affecting the investments. And again, this will be in the operating agreement. Often, as I said, the answer is none. And this is why you need to feel comfortable with the investment itself generally, and more specifically, the sponsor. The question that often comes up as an investor, do I need to get involved in asset protection? This presentation is focused on passive investors. As a passive investor, generally, you're only risking what you've put in the property. You'll be a member of an LLC or a shareholder in a corporation. As I said, the vast majority of these are limited liability companies, LLCs. And the whole purpose behind corporations and LLCs are to take or to give asset protection to all the individuals involved. So nobody's going after them over their particular assets that haven't been invested in this. So nobody's going after your bank accounts or your home or something like that if anything goes wrong with the investment. And there are certain ways LLCs and corporations aren't necessarily completely impenetrable, but the only time that they usually get penetrated, that they go behind the protections, is if somebody does something specifically wrong, such as commits fraud. As a passive investor, you're passive, you're not taking any action. So there shouldn't be any reason why anybody trying to even pierce the corporate veil, if there was some problem, That's a legal term for getting beyond the LLC or corporate status and getting to the individuals. As an investor, as a passive investor, you're not taking any action. So it's very, very unlikely that you would be ever accused of committing fraud or taking any action that was illegal or improper, because your only action is signing a check. And you might have questions, but you've agreed, you've signed on, and you've agreed to be involved. You're not taking any deliberate or overt actions having to do with the investment. Then use of an entity. People ask, should I use an entity or a trust for my investments? And that's really, on the legal side, the asset protection are the main things we're concerned about. The flip side of it is the tax benefit, whatever tax benefits in your overall tax program, and what you're doing with your assets. So it's often more of a question for a CPA, tax professional. There's really no benefits in terms of protection if you're already in an LLC, or no substantial additional benefit in putting your money into a form of entity or a trust necessarily, because you have the limited liability protection of the LLC and you're not taking any deliberate actions. Tax deferral, excuse me. Talked a little bit about 1031s early on and gave a brief explanation of them. Some sponsors might not be comfortable having ticks, so if you have 1031 funds, you want to let your sponsor know as soon as possible when you start considering that I'd like to invest as a tick. Is that something you're open to, a tenant in common? Then the next, if you've gone in as a tick, or even if you haven't, and you're starting to think the asset's going to be sold or your investment's going to be returned to you, plus hopefully a profit, will I be able to defer taxes by reinvesting with the sponsor through a 1031? Sometimes the sponsors will take a group with them who wants to continue to invest and either invest in a fund or another similar asset, anybody who wants to go along with them. So that's a question to ask the sponsor. Is that something that they think about? Or if not, or if I'm not interested in further investments with this specific sponsor for whatever reason, will I be able to split off and do a tenant in common at the sale of the asset? So I can defer taxes into another investment outside of the sponsor. We see that happen fairly often also. As I said, often a sponsor will have people go with a sponsor, but there are others who don't want to reinvest with the sponsor. Either they want to take their returns and they'll pay taxes on them now, or they want to split off and go their own way and they have other investments that they're interested in. So what's often done is called a drop and swap. Right before the sale or in the sale process, often you'll be split off as a tick, even though you weren't one originally, you'll be split off as a tenant in common. And that way the investors take their returns and can 1031 them on their own or do something else with them. The drop and swap is we see it used all the time. Whether it is ultimately effective, we don't 100% know. There's some debate in it with the IRS and things like that as to whether that's effective, but generally it's an accepted practice and we see it happen all the time. So we can't guarantee it, but it is a very commonly used tactic in tax deferral and investment planning. And that's what I had for the presentation. So I am now ready to open it up to questions and answers. And I appreciate your assistance with this, Whitney.
Absolutely. All right. So you had mentioned just, I'm kind of working backwards a little bit here, but that, the time to get your legal counsel involved in reviewing documents is before you actually make the investment. I love that. So kind of what are the typical fees for having a lawyer, partner with a passive investor to review PM, OA, stuff like that?
Usually the fees are hourly on something like that. There are certain groups that will give a flat fee, but going in, every PPM is different from every sponsor. Possibly they can see a template or what they've used in the past that might help. But just like in residential closings, often there's a fixed fee because there's a very small world of what's actually likely to happen. In commercial transactions, the fee is often hourly because you don't know what it's going to look like. They vary significantly. So usually it's just based on the time that it takes to read through the documents and then work with you as the passive investor and helping you understand them, explain them, answer your questions. It's possible that your professionals can reach out to the sponsor and have some input. That doesn't happen all the time, but it's possible that they might be open to tweaking or changing something if there's something that you as the passive investor doesn't like, especially if they hear it from several people. But really, your main goal for your professionals is to help you understand what you're getting into, because you may be one of 5, 10, 20, 30, 50, 100 different investors. We see very different numbers depending on the size of the investment and who's putting it together. So if you're one of 3, maybe that's likely. If you're one of 50 or 100 people, it's probably less likely, depending on what you're investing in, that there'll be any significant changes or any changes to the documents based on your counsel's feedback.
Yeah, I just love the fact that, even just if it's your first time or two, just, or a time or two with a new sponsor, just sitting down and making sure you understand what your investment's all about, because it is a liquid, right? You're going to be partners for years. All right, so this goes back to the TIC investment. So if you invested through a TIC, can a normal investor be required to redeploy at the end so the TIC can continue their 1031?
Usually, if you're investing in a TIC, it's just going to be you or whoever you brought along with you from the previous investment. It's rare, if ever, that somebody's forced to invest in a further investment. If you're part of a fund, there might be a different structure to it, but if it's certainly if it's a single investment and you're a TIC, I've never seen anybody forced along into further investments once that initial investment has sold. And again, as a TIC, it's just you, so you can just usually go off on your own after that. There's nothing keeping you within the investment structure.
Okay. And guys, I did drop a note in the chat box, just so, because I generally, when we have these conversations on webinars, the natural next question is, does, passive investing accept 1031 money? Do we do TICs? Yes, we do, but it's on our multifamily, self-storage, and hotel deals. And there is a threshold, right, for those deals. If you're interested and want to talk further about it, I did put my email in the chat box. Just drop me an email and we can do that. So also, if you have questions for Norm, make sure to go over to the Q&A box, drop them in there, because we've just got a few minutes left with Norm, and I want to make sure we pack in all your questions tonight.
And the reason for definitely having a threshold, and often larger threshold for TICs, is there's more work that's going to be more time, more cost to the sponsor and to the deal itself for putting in the TICs. It's, again, as I said, it's a fairly common thing to see now, but it's adds another entity and another level of complexity. So your sponsors will usually want to have a higher investment amount than just investing as a passive investor in the investment generally.
No, very true. Thank you for clarifying that. That was exactly what I was going to say, but I want to make sure we leave time for everybody else's questions. On the fees, what are good normal average values for the different fees that you listed out? Is there a certain percentage? What are you seeing?
Hold on one second. Get back to the list of fees. Sub-screen sharing is closed. Okay, going back to the fees, they really vary drastically, and the amount of work in all these investments varies drastically based on the sponsor, what's being undertaken, what type of investment it is, the size of the investment. If it's a $100 million investment, the requirements of the lender, that the hoops the sponsor is going to have to jump through and their professionals are going to have to jump through are substantially different than if it's a $7 or $10 million investment. Often a threshold is somewhere around 20 million. It just becomes a lot more or a bit more complex, but some lenders, and it may have a very complex system at a much lower dollar value, but it may be worth it because they're giving a better rate or better terms for whatever reason, but it will very likely vary depending on the amount of work that's involved there.
Okay.
So I know that's a very not a clear answer, and that's what us attorneys are often accused of giving, but it varies drastically.
It's the it depends answer, right?
Yeah, exactly. It depends. And unfortunately, yeah, it varies substantially. You'll just have to get a feel for and different asset classes have different structures and things like that. And it also might be based on the amount of experience of the person you're investing with. Sometimes they charge less, sometimes they charge more, depending on their experience. So again, and I apologize for not giving a clearer answer, but it just really varies, which is very similar to my answer on how much does it cost to have your professionals review your PPM and things like that. I can tell you the factors, but I can't tell you the exact answer on all of it.
I understand. Thanks for trying to answer that. And I know a couple of people did ask about the fees and what are reasonable thresholds. In the chat, I did put in, for me, taking my passive investing hat off, like I'll hide the logo on my coat and putting my investor hat on, I did put in what I look for on like multifamily self-storage deals that I find that it's very common in the market. And that's about a 2 to 3% acquisition fee, maybe like a 2% asset management fee. But again, this all the experience, depends on the experience and what actually the work that the operator is bringing to the table. So that varies deal to deal. I'll see like a 1, maybe 1.5, maybe 2%, some sort of capital event fee, generally hovering around the 1% range. And then also, if you have a key partner that has to pledge assets, there might be an additional fee, in there for that. For me personally, I'm looking for, deals that are, that it's not being feed to death, right? I don't want to see 6, 7, 8, 9, 10 fees in a deal, 4, maybe 5, depending on the work that's actually going into the deal. Like, I don't want to see a construction fee on a deal that has no construction, right? So, again, this is maybe kind of going back to, we can maybe do a webinar on this, a masterclass webinar on this to really help you guys dive into the fees, but and get past that it depends answer. So I know, which can be entirely annoying when it comes to real estate. Go, sir.
And as you were right, the pledge, I just wanted to touch on that to elaborate. Guarantors often do get some sort of extra fee, whether, as I said, there might be a separate asset or class for them if they're not part of the sponsor, or if they're the part of the sponsor, they're risking real assets. And if something were to go sideways, and I mean, it may very well, markets change, things could completely change, major events could change, pandemics could pop up, you never know what's going to happen that might change things. Many of the asset classes weren't hurt ultimately all that bad, but if you had an investment in a hotel during the pandemic, or certainly during the beginning, and you were hoping to get out in mid to late 2020, you might have been not in a great shape. So those guarantors face pretty real risks, and there are certain reporting requirements they have to go through on a monthly, quarterly, annual basis, and certain money that they have to keep very liquid for these. So it's not only are they risking things, but there's additional work, and they're changing the way they do their investments to be a guarantor often.
Yeah, I was trying to multitask and recopy those fee percentages in there and totally botched that up, guys. Sorry, I'll get to that. But yeah, I mean, I look at it this way, just to kind of stack on top of that. I'm not the one having to secure a $40-60 million dollar loan, or whatever that loan happens to be for the project. So that's the way I look at it. I'm taking a passive position in order to be shielded from, that type of, somebody being able to come after my assets like that. So another question, and clarity on that, the question that we had earlier about the catch up in the PPM. The clarification came in that the investor was asking about the cumulative catch up.
Okay, that's part of the asset distribution structure and how the returns are given and how distributions are given. So, and that'll be stated very clearly in the PPM and possibly or often in the operating agreement as well and the other documents. But how, if you're not hitting the returns, if it's will you get to catch those up before the sponsor gets a return, or will if it just didn't hit those and you're just starting as if you're in a whole new period? Is each quarter a new quarter, or is each quarter looking back at what happened before?
So it sounds like it's very much driven by the structure of the PPM and what's in there. And
yes, and you should be able to read through, or you and your professional should be able to read through and figure out that there's a number of different financial terms, as a cumulative, pari passu, all preferred, all sorts of investment terms that you can look at with your financial professionals about that and really determine about how comfortable you feel with the investment and how comfortable you feel that you're going to hit these returns.
Okay. A follow-up question on the TIC conversation. Just to be clear, is it the case that a 1031 reinvestment is always a TIC? If
you're not investing with other people, then there's no other tenants in common, so it's not always a TIC. But I am not a tax professional, but in my experience, anytime you're putting 1031 money in, it's going to have to be in the same sort of structure you were in before. You can't just join a completely new group and just contribute. You can't put your money to buy shares in an LLC with your TIC money necessarily, with a whole bunch of other people and pool it there. You've got to keep it separate. So generally, you would be a tenant in common in the investment.
Okay. And guys, if you're interested in that, if you're in the middle of 1031 exchange, I know I have several going on right now myself personally. Be sure to reach out to me at whitney@passiveinvesting.com, and we can definitely have a larger conversation about that. I have a question. After several, hundreds of investor calls, and this question's only came up a handful of times. Inheritance. Should somebody pass away and they're holding an asset, a passive asset, does how they titled the asset impact that asset being passed on to their heirs?
That is a good question. Let me think through that. That doesn't come up on my end all that often. Generally, the operating agreement will address who can be involved or how the shares get, whether at the demise or death of the investor, if it's an individual, whether what they'll do with the shares and what will happen there. And that's partially governed by your operating agreement and also partially governed by your estate planning purposes. So if you were to have it in an LLC and you died, so you were to invest using your own LLC as a member of the other LLC, then your death probably wouldn't have any significant effect if you weren't a guarantor or anybody that was underwritten in the deal. It would just, the LLC would still own the shares in the entity, and what happened to your LLC would be governed by your own operating agreement and your own estate planning. So it would probably be more seamless if it were an LLC, in that it wouldn't affect your investment at all. It would just be sort of behind the scene paperwork for you. Though if you're the one who died, you probably wouldn't care all that much, but your heirs may, certainly. So that would affect it in some degree and how it would be transferred, because if you were to pass away, and it was in your name, they would have to change. You couldn't continue to hold it in your own name, and afterwards, if you were no longer there, it could be transferred to the estate of, or possibly to your heirs, depending on what the operating agreement provided for.
Very good information. I've always kind of, wondered, like, if it was outside of like an LLC or trust, what happens there, right? All right, guys, we just got a couple more minutes and then we need to let Norm go. We have Amanda and Matt on next to talk taxes. I'm holding everybody's tax question for Amanda and Matt, but if you have
Thank
more,
you for doing that.
You're welcome. You're welcome. I know that I've tortured my my lawyer with that as well, and he was like, "Yeah, no, you got to talk to the other side of the other side." Anyways, guys, this is a great time for you guys to go over to the Q&A box, drop in. You know, we probably have time for one or two more questions. And as people are dropping in their questions, Norm, thank you so much for being here. This is you took away such great value from your presentation, even as a seasoned investor, just all the different questions that you pose to people. I really hope people were, jotting those down and taking notes. Guys, this is being recorded. You can go back. Those are wonderful questions for everybody to consider before they get into passive investment or even how to evaluate one. So.
And to your point about how your attorney or your tax professional, I've made that distinction a lot of times, but it's certainly ideal if you get people in your corner that you feel comfortable with before you get a private placement memorandum, and because you'll have a fairly short amount of time usually to subscribe, and there's a whole process of, we're not going to get into that, but to subscribe. But not all attorneys are work in this area the same way. Not all doctors are ENTs or pulmonary lung doctors or heart doctors and things like this. So both legal professionals and tax professionals that can assist you in evaluating these investments and things like that. You want somebody that works in that specific area, not just because it's your brother's friend, your father's friend, your friend from church. You're putting often up substantial amounts of money, so you want to be able to evaluate things as clearly and as well as possible for you.
So that brings up a great question here. What type of attorney are people looking to partner with?
A good one.
A good one? I mean, business attorney, securities attorney, definitely a good one. I got that.
The securities attorney is probably secondary to the investors. I mean, it certainly doesn't hurt, but the sponsor's more concerned with that because they've got the risk if things aren't properly registered or exempted from registration, but that's its own set of registrations to exempt it from full registration. That's more a sponsor, I'd say more a sponsor concern. A commercial real estate attorney, and one in particular that has experience possibly working with sponsors ideally, so they can see the whole side of things, but certainly somebody who's experienced in commercial real estate, ideally one who represents sponsors and deals as well, so they see the full set of issues that come up and that they do it on a regular basis. Preferably not somebody that does family law, estates, and traffic tickets as well. You want somebody, these are fairly high level things, and usually somebody who specializes in commercial real estate / commercial investments and things like that.
Awesome. Well, Norm, thank you so much for joining us today. This has been wonderful. How can people reach out to you if they would like to connect?
Feel free to reach me at here. I will put it in I'll put my email in the chat box, and that'll make it easiest.
Perfect.
And I want to thank you for having invited me. It was very enjoyable.
Excellent. Yeah, guys, if you are, looking for, legal support, you can reach out to Norm and his firm. His email is in the chat box. Guys, again, thank you so much. We are going to transition now to the tax side of our presentation. And Norm, we're going to bid you a great farewell. And we're going to have a fantastic night, Norm. And then we ask that now we're going to take like a quick minute, stand up, stretch. I mean, we're in for a couple more hours of wonderful information. We have Amanda Hunt and Mac McFarland with Keystone CPA. They are joining us live. Hi, Amanda. Hi, Matt. You guys are on mute. We have tons of questions already populated for you guys. So I know we could probably do a whole entire session just Q&A around tax, but just to kind of make this really concise in the short time that we have, because I know we have to keep a very tight schedule for Matt, for you, I want to go ahead and kick you guys off, just give a brief introduction and let's dive right into your presentation.
Yeah, well, thank you so much for having us. We're really excited to be here. My name's Amanda Hahn.
And I'm Matt McFarland.
And so we are CPAs. Our firm is called Keystone CPA, and we specialize in helping real estate investors nationwide to save taxes. And so our clients include people who are passively investing, as well as people who are actively syndicating deals. So we kind of represent both sides of the coin. And outside of what we do in our day job, we're also real estate investors as well. So we have our own real estate holdings that we're somewhat actively involved in, and we're also passive investors in other people's deals too. So we're just like all of you guys here, essentially.
And we are all also married to each other. So it's not normal that we hang out in the living room of each other's house, I guess. Or it is normal, I suppose.
Yes. And just a disclosure, we were tested positive for COVID just a couple of days ago. So we're right now in our ADU, quarantined away from our kids.
Hiding from the kids.
Yeah, hiding from the kids and my mom. So that's why here we are.
So you get a little vacation out of this.
Yes.
But I was quarantined first, and then she got it like 2 days later. So my vacation ended as soon as she got quarantined.
How sad.
Did I say that out loud?
I was gonna say that was your out loud voice, Matt.
No, sorry.
Remember.
Having this conversation in my head all week. It's really weird.
That's so sad. That's so sad. But anyway, we're really excited to be here. And what we thought about in preparing for today is that we thought we might just kind of try to cover some frequently asked questions. So like I said, we work with a lot of passive investors, and we also work with the sponsors too. So I feel like we get FAQs from both sides of the coin. So we can start there. And of course, I think Whitney said you guys have already gathered some questions from when Norman was talking. So we'll try to leave plenty of time to go over those. So I think to start off, one of the most frequently asked questions is, are there any tax benefits of being a passive investor? I hear a lot of people who will say, oh, my CPA said that all those great deductions and benefits are only for people who are full-time real estate. And when we're passive, we don't really get any of those benefits. And that's not necessarily true. So investors who only invest passively through syndications, they do get many of the same benefits as those who invest maybe in a single family home on their own. Okay, there are going to be a few differences which we'll touch on today, but some of those major tax benefits are the same, whether you have your own rental property or if you invest in a syndication.
Yeah, I mean, think about it. It's like when you buy your own property, the goal is to buy a property, get cash flow positive, right? But you're using depreciation and other tax strategies to kind of, bring that number down to zero at the very least, right? You want it so you got cash in your pocket, not paying taxes on it. If you can use, depreciation to create a loss, and that's even better. And, maybe we use that loss, but slowing down for a second, that works the same way in a syndication, right? A syndication is a passive investor. The syndication, the goal is to buy properties that are appreciating in value, but are going to get cash flow positive, but they're going to use depreciation and other tax strategies so that, from a K1 perspective, hopefully you're getting a K1 that has zero income on it or even a loss, but you're also getting a cash distribution in your pocket. So it works the same way, that you're getting cash and hopefully not paying taxes on it right now because of the depreciation and other things.
Yeah, I think if you have a single family home, let's say the building's $100,000, first year right now, because of not only do we get depreciation, but you can do accelerated depreciation. This year there's bonus depreciation where some of those we can get 100% write-off. So, industry average on $100,000 worth of building, you probably get about $30,000 of write-off. So on the syndication perspective, it's just supersized, right? So instead of a $100,000 property, it's maybe like a $10 million property. Instead of a $30,000 write-off, maybe it's like a $20 million write-off. Now, of course, it doesn't mean that would be, oh, sorry, that's our son getting ready for baseball. So it doesn't mean that you're going to get all of that benefit yourself, right? As if you're, one of 50 or 100 investors, you're going to get a share of those write-offs, but effectively all works the same way. So do passive investors get tax benefits? Absolutely, right? If you're in the game to get cash flow, you might get cash flow free from having to pay taxes currently. If you're in it for appreciation, you're likely getting appreciation without having to pay taxes currently. And this is available to all types of investors, including those who are just purely passive in syndications.
Yeah, what are some other questions? I think so. I think a lot of times then people say, okay, well, if I'm investing my own stuff, I generate a loss, maybe I can use that loss to offset my other income, and there's times when you can do that, especially if you're a real estate professional. So that can still be beneficial as a syndicator, or you're investing in a syndication, I guess the question we get a lot is, can it lower my investor's tax? I'm the investor, can it lower my tax on other income, W-2 income, all that kind of stuff? And generally the same rules apply. Like if you can qualify as a real estate professional on the side from your own investments, and you happen to be investing in syndications as well, then those losses you get from the syndications, you can still use to offset your other income, your business income, your W-2 income, interest, dividends, whatever the other stuff might be. So that's the same rules and same benefits can still apply.
Yeah, actually, I think we have a lot of clients who have a couple of their own single families, right, that they've kind of built up over time. And if they have enough hours, they're doing enough on their own properties. Oftentimes they're like, hey, I don't want to own my own apartments. I don't want to have my own shopping centers that I have to deal with. I do want to get into those types of investments, but just not by myself. I don't want to do that much work. And so that's a great fact pattern where as long as they're qualifying as real estate professional on the properties that they themselves own or just through their own LLCs, then continuing to invest in syndications that's kicking off larger tax write-offs is really helpful in having, in helping them to offset taxes year after year. Because we do see that a lot with clients, right? Initially, they start out with a couple single families and they're really happy and they love all the tax savings, but at some point they're like, wow, this is turning into a job and I don't want that to be my job, right? I started out this journey wanting to be a passive investor, having passive income at least, right? We don't call it passive investor, but I wanted to have passive income, but now I'm finding myself more active than I want to be. So this is a great middle ground where as long as you're active with respect to some of your properties and you can reach real estate professional status, a lot of the losses that's coming from the passive syndications is still very, very helpful in terms of tax savings. Right?
Interject really quick with a question I got asked earlier. I did a presentation a couple of weeks ago about the lazy 1031 and where essentially you liquidate a property and if you can't go through a 1031 exchange, you take all that capital, right, within the same year and go invest in a syndication to acquire the losses. And so somebody just wanted me to kind of like ask, like, is that legit? Like, can you, obviously I know in my head, it's not 100%. It's not as powerful as doing a 1031 exchange, but could you give us an illustration where that could still be a very powerful way to impact your taxes?
Yeah, definitely. It's from a legitimacy perspective, yes, right. There's nothing, the tax law allows you to offset capital gains from sale of rental properties, allow that to be offset by rental losses. And so rental losses include depreciation, bonus depreciation, all those things that you might get from a syndication. So that is allowed. And in fact, we're seeing that quite a bit. We have clients who sell an appreciated property. They have all the best intentions of doing a 1031 exchange. But as you guys know, the market has been a seller's market. And so they're stuck with this decision of, okay, well, I'm either going to have to buy this deal that's not as ideal for me. It's not really what I'm looking for to save on taxes, or I'm going to pay the tax. And so,
or I just can't get it done by 180 days or whatever,
Yeah.
Or identify the property in 45, right? Like,
right.
Yeah. And so, so this is where, investing in a syndication in the same year is kind of what we consider an offset strategy. So your first plan, which is the 1031, the benefit of the 1031 is that it allows you to defer the entire gain if you're doing it correctly. In an offset strategy, it's a little bit out of our control. So for example, if I sold a property with $100,000 worth of gain, I did the 1031 exchange, I defer taxes on the whole 100,000 gain. But instead, if I'm going to take that, that $100,000 invest in a syndication, hopefully the syndication will give me a tax loss of $100,000, right? Or maybe even more. But again, that's outside of our control. Maybe the syndication is only going to give me a $60,000 loss in the first year, in which case it's still good. I've offset 60,000 of my gain instead of paying taxes on the whole 100,000. So it is a good offset strategy for the people who, didn't do a 1031 exchange or chose not to do a 1031 exchange.
And part of the reason why this can be beneficial and work right now is because of, what we call bonus depreciation. So in that example, right, you've sold a property, you've got some gain, you've invested in it, somebody else's syndication that you don't control. But they could even, they can go into the syndication and go out and buy that property in December. And because of the bonus depreciation rules, maybe the syndication is doing a cost segregation study, they're still able to get a lot of depreciation, even though they've only owned the property for, say, 3 weeks. Whereas if they didn't have bonus depreciation, it would be like a 1/12 amount of depreciation, or, so that's why it's the opportunity is available right now. Right now, bonus depreciation is still at 100% for the 2022 year. It is set to go down to 80% next year, which is still better than nothing, but it's, so that's partially why that, as you kind of term it, the lazy 1031 exchange can work right now.
Yeah, I like that name. I've not heard that term before. I think I'm going to start using it.
I've heard it from several different areas, and Jim Pfeiffer, before I did that presentation, he was like, "That's what I called it in my blog," and I'm like, "You wrote a blog about it?" Anyways, somebody somewhere needs to trademark that.
Yes,
get Norm back on, right?
You should trademark that. And so that strategy is true, regardless of whether someone's a real estate professional or not, right? So if you're just a passive investor, and that works even just outside of a 1031. So for example, you invest in one syndication, that asset is sold and you have a large gain. Well, you can take the money and invest in another syndication, and then the losses will offset the gain. It's not a 1031 exchange by any means. Similarly, it's just an offset, right? We couldn't reduce the taxes directly, but what's another offset strategy that we can utilize?
Yeah, that's what I like for those people who are not real estate professionals. Sometimes they're saying back, well, I got a K1 that has a loss. Like, how am I going to use that? But you'd be surprised. There's a lot of investors, obviously, that syndication they've invested in, it's not the only one they've invested in, right? So they might have some other ones that are kicking off profits. So you're going to use the losses from the syndication with a loss against the K1 with the profit. Could be real estate, may not be real estate. We have, clients who are doctors. They've invested in a surgery center that they don't work in all the time. So it's passive to them, and it's kicking off a lot of income. It's very profitable, but they also have these real estate investment syndications on the side. So they're able to use those real estate losses to offset this passive surgery center income. And so that's another way to offset your taxes that that doctor would otherwise be paying on that profitable surgery center.
Yeah, or just investors who maybe have owned their own investments for many years, that where on their own properties they've probably maxed out on depreciation. So we see this a lot with older investors, right, where they have a portfolio of properties that's just very high cash flow, fully depreciated assets. So they have a tax problem of having too much rental income, but they don't necessarily want to go into the stock market because real estate is what they know. At the same token, they don't want to start buying apartments and managing it. And so this is another area where they see passive investments into syndications as a really great strategy, not just from the investment side, but also from a tax perspective too, because it's generating the right type of losses that they can utilize. And so, this all just to go back to this notion that I think a lot of CPAs will tell people, you get no benefit when you're a passive investor. And that's absolutely incorrect. There's so many different benefits. And that statement, I feel like, comes from a tunnel vision of, I'm only looking at passive investments versus W-2 income, right? If that's all they're looking at, then sure, maybe you're not getting a current benefit. But, and when we look at taxes, we always look at it from an overall perspective. So let's say someone who makes, $500,000 worth of W-2 income, and they get $500,000 of rental income, right? In an extreme scenario, this is a happy person. So before, they always had to pay taxes on their $500,000 of W-2 income. That's just how it typically works. But now they also have $500,000 of rental income from cash flow that they don't have to pay taxes on. right? So now all of a sudden they have $1 million worth of income, but their taxes remain the same, that they're only paying taxes on their W-2. So still a really, really great position, I think, for any investor to want to be in, right? So when you say passive investors don't get tax savings, that doesn't make any sense at all when you're looking at the picture in totality.
I think that along the same lines, I think, that's it's a common misconception is, hey, I've got, we kind of mentioned this, right? But I've got a distribution check from this K1 investment. So, we asked the question, CPAs will ask the question, what's your profit or loss going to be from this syndication? Or, like, well, I got a distribution check of 30 grand. So that's going to be my income, right?
Yeah. Or we have people who will call us and say, oh, I invest in the syndication. I just got a 30,000 distribution. Can you tell me how much taxes I'm going to set aside to pay that? And what we typically tell people is, hey, the distribution check does not necessarily mean you're going to have to pay taxes on it.
Right. Because it's a whole thing of distribution is not necessarily the same thing as income or loss from the partnership. The $30,000 could just be a return of your original capital, where there is no profit or loss for the year, and you're just getting a $30,000 check back because they had excess cash laying around. It could be from profit, but even if it's from profit, again, cash flow profit, if we've got doing depreciation right, that's going to hopefully shelter that, so you're not paying taxes on it. So I think that's a common misconception is that, yeah, I'm getting a check and I'm assuming I have to pay taxes on that. That's not always the case.
Yeah. I mean, when people ask us, we always say, okay, well, you got the distribution, but what was it invested in? Was it like a real estate development where something was sold? Then, odds are that it might be something taxable. But usually if it's rental real estate, apartments, mobile home parks, typically we have a, pretty high comfort level. There probably won't be a lot of taxes, especially in the first couple of years of the syndication, right? That there's usually a good amount of write-offs and things like that. Go ahead. Did you have a question?
I was going to say, I thought I had a question come in. Especially when we're talking about those early years of the hold when we get a lot of losses. A question came in, if there are items that were depreciated on a 5-year schedule and it's been more than 5 years, do you have to pay recapture on that?
That's a good question. And no, I think I would make the argument, and I think there's plenty of case law and tax law and, historical stuff to support it, that especially if it's been more than 5 years from when you bought the asset that you just started depreciating stuff on a 5-year schedule. They give you a 5-year schedule for the purpose to say that that's presumably going to be worthless in 5 years, right? Because you've used it all up. And, the 5-year stuff in the real estate world and on a depreciation schedule is typically like furniture, fixtures, appliances. That stuff's not appreciating in value. I mean, even if your property is as a whole, that stuff's not going up in value after 5 years. So yeah, very fair assumption to make that if it's been, you bought it 7 years ago and you're selling it, the sales price you may have to allocate it to it would be zero. So, if you fully depreciate, you shouldn't have to pay recapture on it.
What else? The other thing I like about being a passive investor is that for the most part, the tax planning is already done and taken care of for you at the syndication level, right? So for example, when you buy your own single family or duplex and you're operating the property, then you would be the one to determine whether and when to do cost segregation, to do accelerated depreciation. And then if you determine that was a good thing to do, you would then go out and hire and pay someone to do the work, right? And then you report it on your tax return, or your CPA is going to have to know how to report on the tax return. When you're a passive investor in a syndication, most of the time the syndication is the cost segregation will be done at the entity level. So the sponsor group is going to be the ones to go out and get the cost segregation done. And so what you see is at the end of the day, after everything is said and done, you'll just see that tax loss on the K1, right? So just like the operational side for you is passive, so is the tax side, because it's sort of already done for you. You just kind of see that net number. And we do have clients sometimes who, when they get a K1, they'll kind of have a little panic attack and say, oh my goodness, I invested $100,000 and I got this $100,000 loss on my K1. My money is gone.
Yes.
So we have to talk to them about, what that looks like and why they're seeing it. mostly probably because of depreciation write-offs, right? I mean, not always the case, but typically the biggest chunk of the tax loss is going to come from the paper loss of depreciation.
So we've been talking a lot about depreciation and gains and losses and all that. How is this impacted if you invest through like a retirement account, like SDIRA?
Great question. So for self-directed investing, and I think Scott is going to talk after us, right, about self-directed investing. So from a tax perspective,
so we'll load him up with, we'll load him, tease all these questions. We'll force him to answer.
Yes, and Scott will talk about
I've got tons of UBIT questions for him too, and he always told me ask.
Yes,
ask
yeah.
the
I'm sure he's
CPA.
going to say talk to the tax person.
Our audience.
Sorry, that's the benefit of going first. We get to punt to the next person.
So from a retirement account investing perspective, yes, I mean, retirement accounts, self-directed IRA, self-directed 401k, those can all be used to invest in syndication deals as passive investors. The thing that we always tell clients to watch out for is if you have a self-directed IRA or a Roth IRA, you have to be careful if the syndication is investing in a deal that has leverage. And the reason for that is if the deal has leverage, meaning, at the entity level, there's debt involved, then there are times where the retirement account may have to pay taxes when there is taxable income shown on the K-1. Now, naturally, this is not going to be a problem in the first couple years of the ownership, just because, with write-offs and things like that, you typically have a tax loss. So when there's a loss, doesn't really matter. There's no taxes anyway. Where we typically see this as a tax issue is upon the sale of the property. So when the property is sold, if there's still a significant amount of leverage, then it's important for the investor to know that the self-directed IRA might have to pay unrelated debt financing tax. It's short for short term is UDFI when investors use an IRA or a Roth IRA. One of the easiest ways to get around that is to invest with a self-directed 401k instead. So if you're someone who's eligible for a self-directed 401k, that's typically the better vehicle to use. And I'm sure Scott is going to talk about the difference of, IRAs and 401ks in the self-directed world. But that's kind of the easier way to do it. And we also have investors who maybe if they're not eligible yet for a self-directed 401k, they start out making the investment in their self-directed IRA. And then when they're eligible for a self-directed 401k is when they then just transfer that investment into the solo K. Typically, again, before the exit of the deal, it should all still be, okay in terms of avoiding that UDFI tax.
So there was a follow-up question. Different investors said, I changed title of an apartment investment from traditional IRA to an IRA LLC. Maybe I jumped the gun here. I thought it was a 401k. I didn't pay attention to my K1s for a couple of years and found that out the K1 still referenced my traditional IRA. The investment just sold. Can I ask my CPA to take the losses reported on my traditional IRA and move them to the IRA LLC?
So this is going to depend. So if the IRA owned LLC is owned by the same IRA as the original traditional IRA, I guess, in this example. So, you invested in, I don't know, UDirect IRA, but then you created a LLC that's owned by that same IRA, then it all for UDFI purposes, that would all roll up into the same thing. So that shouldn't be an issue. That should be all be on the same. If an IRA is going to file a tax return and do UDFI, it's going to be a 990T form. So that should be the same 990T. Now, if it's a separate, the IRA LLC is owned by a separate traditional IRA than the original one, then I'm not aware that those two can offset each other, because I think the way they have the 990T rules now is you got to file separate tax returns for each IRA. And I think that would be challenging at that point in time.
Okay. So back to the solo 401k. Sorry, I got us off track on that conversation. I guess a question I would have is if, say, for me, like I invested through a self-directed IRA, then I qualified for a solo 401k, made that transition, everything was hunky-dory. But what if an investor went into self-directed IRA, still doesn't qualify for solo 401k? Is there any way that they made a passive investment? Is there any way they can mitigate UBIT at all?
Yeah, I mean, there's a couple things now. Obviously, if they've invested in somebody else's syndication, some of this may be out of their control. But one of the things that is in the UDFI world is that if you can, let's say, fast forward to the date of sale, right? Because early on, obviously, you're getting K1s that show losses. Maybe after year 3 or 4, it kind of turns into a small profit from cash flow or whatever. But the big chunk of profit's going to be hopefully in the year of sale down the road. Couple things come to mind. If it has kicked off losses in the first couple of years, our recommendation is usually to file the 990T to capture those losses so that you can carry those losses forward and use those to offset the gain in a future year. So that's one way to help mitigate the issues. So a lot of times investors say, oh, I got a K1 that shows a loss, I'm not going to file a 990T. Well, if you don't do that, then you have no losses to carry forward to offset the gain in the future. So that's one thing to keep in mind. The other one is they have this, if it's a syndication, maybe a little out of your control, but if they pay down the debt a lot before 12 months before the sale, so
A year before the
a
sale.
year before the sale. So they have a look back rule that says, what was the average debt a year ago? And if they had paid it down enough before a year comes up, then it can reduce the impact of the, on the sale, because on the date of the sale, maybe the leverage portions, instead of 50% is now down to 20% or 15%. Then the portion of, gain that you're going to pay tax on is a lot less than it would have been, had it happened a year ago, if that makes sense.
And then the other thing I wanted to say too is that when we talk about the unrelated debt financing tax, if it's on cash flow, so let's say just we're keeping the property, we just have taxable rental income, it's usually at the highest trust tax rate, which right now I think is 37%. So that's pretty steep. But again, we typically don't see in practice, we don't really see this as an issue because during the whole time there's depreciation and things like that. So the times when we actually see UDFI be an issue on leveraged syndication investment is on the sale. Excuse me. And the good thing about that is on the sale, it is considered capital gains on the UDFI. So it's not at the 37%, but it's at the capital gains tax rate. So on the higher end, it's 20%. So it's still a lot lower than, what a normal UDFI is in the operational sense. So yeah, I think in addition to just making sure you file the returns to capture the losses so you can reduce the gain, and then whatever gain is remaining, making sure your CPA is well-versed in the 990 route and that they are using the lower capital gains rate to calculate the taxes, because that's something that we've seen done incorrectly, unfortunately.
So a follow-up question to that is, somebody was asking, in relation to this, is it possible to have the profits distributed over multiple years so the tax can be lowered?
It's possible, but again, it might be out of your, to some extent out of your code. Now, when you say profits, it's all going to come down when you do your IRA, or even you individually invest in a syndication. The profit or loss is all going to be dictated by the K1. So are they going to issue a K1 over 5 years that's showing a spread out profit? If there's a way for them to do that, that could work. But if we're just talking about distributing cash over holding on to cash and distributing it 4 years later, that's not going to change the profit or loss in, quote unquote, the year of the sale.
Yeah.
But I think, another thing that came to mind too, is we were talking earlier about one of those offset strategies, like the lazy 1031, where, you can do the same thing with your self-directed IRA. Maybe your self-directed IRA invested in a syndication that sold a property in March, and it's going to, give you some cash back. You're going to have a big gain. You're going to have some UDFI issues. There's nothing to prevent you from using your self-directed IRA to reinvest in some other syndication before year end that's going to kick off a big K1 with leverage depreciation and losses that you can use to offset that same gain from earlier in the year.
Very cool. Very cool. So what are some other questions that you commonly get from passive investors?
Let's see. People always ask, like, if losses from one syndication will offset income from another syndication. We kind of touched on that a little bit in terms of gains, right? So one syndication sells, you invest in another syndication that has losses, they offset each other. It works the same way when it comes to just cash flow. So if I have a syndication investment that has high cash flow, and I have losses from another syndication, they can be pulled together so that one of the gains offsets the losses. And this is true regardless of any entities, right? So own individually or in your LLC, that all works exactly the same way. The only time one doesn't offset the other is you versus your retirement account, right? So if I have, I'm using my IRA to invest in syndication that has losses, it's not going to offset my rental income or my investment in some other syndication. That's the only sort of limitation.
Kind of sounded like Joe versus the volcano there.
Yeah.
I think another, I mean, funny to us, I guess, but not funny in a real world sense. But sometimes we'll get the question, "Hey, I'm ready to file my taxes. Why can't I file them yet?" It's like, well, because you haven't received your K-1s yet. So that's a real world thing where, some investors don't understand that, you need that K-1 from the syndication before you can file your tax return. So that's why it's, hopefully you're working with good syndicators who are on the ball and getting those done, by, March, early April, the latest every year, if they don't have to extend for some reason,
Yeah.
And then a couple of questions after that. Past couple of years, the tax deadline has been extended. We've seen a lot. I mean, I would say across all of the syndicators that I've been invested in, one has delivered on time this year. And historically in the past, they have.
Was it one of our clients?
Actually, yes.
Oh.
Yeah. But anyways, long story short, is what can, because I want to actually help investors understand that there's something they can do in this situation and then it will be okay. And so what happens if, K-1s come in like April 14th, right?
Yeah.
Like, or heaven forbid, May 1st. What happens in that situation?
Well, so I think there's two different things. And I'm speaking also from the syndication's perspective. What I always tell our syndicator clients is if you're going to have a gain, like you sold the property, we want to get the K-1s out. Why? Because the investor might have to pay taxes, right? We don't know every investor's profile. They might have to pay taxes and you don't want to surprise them on April 14th. Right.
Mm-hmm.
But in a normal scenario, again, especially in the earlier years of a syndication, the expectation is those K-1s will be losses. And so from an investor's perspective, it means it's not going to add to your income, right? You're not going to have to owe additional taxes because of the syndication investment. IRS does allow everyone to have the opportunity to file extensions all the way through October 15th. And all that is required is that you file the paperwork and you pay any taxes that you think you might owe. So if you're someone who has a lot of syndication investments and you already know nothing is going to come in by April 15th, or even if it does, you don't want to rush on your tax returns, then what you can always do is you can send all your paperwork, like all of your information to your CPA. They can prepare the tax return. And all they're doing is they're just going to wait on that final 1, 2, or 3 K-1s, right? Again, if they're like most syndications, the K-1s will be losses. So it's not going to add to your income. And so as long as your CPA has all your information, they can tell you this is how much the most that you might have to pay if you're going to owe at all, right? Or if they think you're going to have a refund, then it's just a very simple paperwork that they file with the IRS to get you on extension. And then you just have additional time to wait for the K-1 to come in. Again, you have all the way to October 15th. Even outside of syndication investments, just, for taxpayers in general, we tell a lot of our clients to file extensions because the tax law is always changing. And a lot of times we look at multi-year tax planning. So meaning right now, we can still decide, do we want to do cost segregation for last year? Do we want to take a deduction and accelerate something for last year, or am I better off waiting to take it this year? And maybe I didn't have that insight in January or February, but now that I'm in June, I have a better idea. What's the tax law this year? What is my income looking like in 2022? And it gives me better insight to decide by looking at both years, what makes more sense, right? So I think for a lot of investors who maybe are used to filing in January, February, that might be something to consider. Give yourself the time to be able to do multi-year planning by filing an extension.
Yeah, and I think kind of the big takeaway is just have an open line of communication with your CPA and also those syndicators that you invested with. Just asking the question of, okay, yeah, I understand the K-1 is going to be in May or June, but just for extension purposes, what is my estimated share of the net income or loss for the company for the year? We're not asking for an accurate, totally accurate figure, but give me an idea so that, again, we're not gonna have any surprises from an extension and paying tax perspective.
Like you're gonna owe $100,000.
Oh my gosh, yeah. Kind of pivoting a little bit. Like I said, I have a ton of questions, and I know there's. I want to give a few minutes too to anything you guys have. Well, let's start there. Do you guys have anything that you feel that passive investors need to know, like right now, like common questions that you get that we haven't covered?
I think the only major one that we had coming in was 1031 exchange. We kind of touched on that a little bit, but this one we get all the time. My syndication is being sold, and can I do a 1031 exchange? So if a 1031 exchange is to be done, it will be done at the syndication level. So it's not a choice that we as passive investors make. The sponsor will be the one to make that decision. If they have decided not to 1031 exchange, then you cannot 1031 exchange your 5% ownership of that syndication investment. But you can certainly use the lazy 1031 exchange strategy that Whitney talked about.
Trademarked.
I wish I could. I wouldn't feel good about it because somebody told me about it.
Hey, maybe hey, as long as you're first to file it, it's fine.
Yeah. But effectively it's offset, right? If my syndication investment is going to have a huge gain for taxes, I can't 1031 exchange, but maybe I'll invest in another syndication. And if that syndication is going to send off losses to me, I can use it to offset the gain from the first syndication.
So I guess a question came in. Any preference to the 1031 versus avoiding tax through the bonus depreciation on the next investment? I'm assuming it depends on the amount of the sale. So
yeah, anytime you're looking at a 1031 exchange, whether to do it or not, it does depend on are you gonna owe taxes on it, and if so, how much? But from a 30,000 foot level, comparing the two, 1031 exchange is probably the preferable route if you can do it because you are deferring the tax right now anyway. With the alternative strategy, you are recognizing the income and having to use a deduction to offset it. Whereas if you use a 1031, you're not recognizing the income at all right now, and you can still have that deduction to use against potentially something else or save it for a future year. So all things being equal, probably the 1031 is the preferable route. But again, if you can't do it because it's a gain from a syndication investment, then you got to do what you got to do, right?
And if somebody used the offset strategy or the lazy 1031 strategy, does it only offset the gains, or would it offset any recapture?
It can offset both. So we talking gains. I'm talking the whole picture. The depreciation recapture is part of that, but yeah, it could offset both.
Yeah, we have smart audience members who are differentiating the two. Or is that just your question, Whitney?
No.
That's for a friend.
Yeah, right. Trust me, I've got several notes here. I got a question for a friend. A follow-up question here, or one that came in the case of my K1s were titled to the old IRA and not to the new. So this is back to the investor where we had the movement, that IRA and the LLC. So do I have to do anything with the IRS? Will it come back to me to bite me? I never filed any 990Ts.
Well, the 990 is filed in the name of the IRA and not the LLC anyways. So if you have to file the 990, it would be in the IRA's name and the IRA's tax ID, right? The LLC itself is not going to file the 990. So should be fine. I think it sounds like you formed this IRA LLC, but the K1 was never updated. So as far as IRS is concerned, your old IRA has always been reported as the owner.
And then if never having filed 990Ts for the original IRA itself, anything to worry about? It depends on the numbers on the K1s. If there's enough income on the K1 to somehow trigger some sort of, potential look at it from the IRS, like, hey, we, expected this IRA to file a tax return and it didn't. There is no when you don't file a tax return, there's no statute of limitations that says the IRS can't come after you after X number of years because you didn't start the clock ticking by filing a tax return. So, if there wasn't substantial gain, probably nothing to worry about. But yeah, if there was substantial gain, then that the clock could be ticking for a long time, unfortunately.
Oh, I think you're on mute.
well, that's not going to work. I know we have to get you guys out of here in just a few minutes. Any other burning questions that we need to go over? Otherwise, I'm going to, encourage people to drop in maybe 1 or 2 questions to the Q&A box.
Oh,
No, I have them drop in the Q&A box. We've teed up all these UBIT and UDFI questions for Scott, so he should be ready to go.
Yeah.
And he's he stepped out of the room.
Yes. Yeah.
Let's see here. Let's see. We did have one. This was more around. Let me see if I can go back and find it. There's a lot of questions that kind of came in that were similar.
Frenchie has a question, and will there be any legal changes regarding QRP 401k plans? So we can't really comment on legal stuff, but from a tax perspective, no, nothing we've seen in terms of, the definitions of QRPs or 401k plans. Those plans have been around forever. Probably changes to, just the annual contributions as that occurs every year. But in terms of the definition and things like that, we have not seen any proposed changes.
Okay, so I found the question is, I have a rental investment that for personal reasons will probably be a short-term hold. Can you discuss depreciation recapture? I am not sure I understand it very well. I've been told that the cost segregation wouldn't be cost effective for a short-term hold.
Yeah, so generally speaking, when you look at somebody looking at doing a cost segregation study, it is, all things being equal, more beneficial to longer term, longer you hold a property after you do a cost seg. Because with the cost seg study, what we're trying to do is generate more depreciation, take it now, and through present value of time, say, that whole thing, you're going to get some savings over time. Now, if you're going to only own the property for like a year and you do a cost seg study, then whatever accelerated extra write-offs you got now, you're gonna have to recapture a year later anyway and pick it up back up in the income. And harder to make that argument that, hey, my 5-year assets aren't worth anything a year later, to try and get some of that gain to go away. So, does it always, if not always the case, if you're gonna hold a short term, that you shouldn't do a cost seg study. But again, all things being equal, it works better, and the longer you hold a property.
And there's also an expense. It's not cheap to do a cost.
Oh yeah. You've got the cost of doing it. And you always want to, anytime you're doing a cost seg study, you always want to make sure that, the benefits outweigh the costs, obviously.
Yeah, but I do want to say though, because you mentioned it's not cheap, but it's actually not super expensive. In the past, I know there's this assumption that cost segregation is only for large commercial real estate, but because of bonus depreciation, right, the fact that we can write off so much in the first year, we're seeing huge benefit in properties that maybe are $250,000 or more. And it has, with COVID, a lot of the cost segregation firms have learned or taught themselves how to do things virtually. And so what we've seen is the cost has come down quite a bit. So, if you spend $2,000 on a cost segregation project, that's going to save you, $30,000, $40,000 or $50,000 in taxes. That's definitely worthwhile. Like Matt, what Matt was saying, the short term typically doesn't make sense, but there are always anomalies. Like if this year I'm in a 37% tax bracket, next year I'm going to be 12%, then I still might do cost segregation because I know I'm going to save more taxes this year and pay it back at a much lower rate. So.
Very cool. Very cool. Well, guys, thank you so much for joining. How can listeners reach out to you?
The best place to find us is on our website. We try to do a lot of tax updates, webinars, and we also have a ebook that people can download. If you want to learn more about tax strategies, maybe just outside of passive investments, we talk a little bit about income shifting, how to take a tax deduction for paying your kids, or what are the tax considerations of setting up legal entities, probably different than what Norman was talking about. And we also talk about self-directed investing from the tax side. So we'll throw that in the chat. You can check those out on our website, which is keystonecpa.com.
Awesome. Well, thank you guys so much. I got you out 1 minute early.
No, thank you for having us.
Yeah, thank you. Bye, guys.
Yeah. Bye, guys. Thank you again.
Bye.
All right, guys, let's also stand up, take a moment, stretch. That was a wonderful conversation that we just had with Amanda and Matt about all things taxes. And Scott, we're so glad to have you here. We saved all the QRP questions and the UBIT questions for you. I hope that's okay.
That is fine. I caught the end of some. I was not going to jump in because I figured we'd talk about it during this session. So
anyways, guys, Scott Marr with Advanta IRA, you guys have probably caught him a couple times on the master class, but I thought, when we're bringing in experts and really trying to help you guys shortcut the path to building your team and getting some of these core questions that you need to have answered up front to go into those passive investments with confidence, I had to bring Scott in. Scott, just maybe recap just a little, really quickly who you are, who Advanta IRA is, and what it is you guys do, and then we can launch into your presentation.
Sure, absolutely. Yeah, my name's Scott Maurer. I'm the Director of Business Development for Advanta IRA. We are a self-directed retirement plan provider. So we assist people who have their IRAs, their Roth IRAs, the solo 401k or QRP accounts to invest in all types of alternative assets. And we focus, though, a lot of our education and presentations on real estate related assets because that's where most of our clients are investing. Our company's been around since 2004. And actually, that's the only thing we do is self-directed IRA accounts or self-directed solo 401ks. So that's we do a couple of events a week on our own, and we really just like to educate. So I'm really happy that Whitney, you invited us, or invited me, I guess I should say, to be a part of your event today.
Yeah, thank you so much for joining. Well, I know you have a little bit of a presentation. You should be able to share your screen. So let's go ahead and go through that. Guys, if you have questions, I already dropped a little bit of direction in the chat box, but make sure to go over to the Q&A box because sometimes we get duplicate questions. I want to make sure that I can moderate the questions for Scott. And we'll do about 20-25 minutes of a presentation and we'll open it up for Q&A. Guys, anything goes. Let's pack in as many questions as we possibly can.
Okay, can you see the full screen of the slide? Just want to make sure I'm sharing the right slide. All right, great. So today's presentation that we're going to go over, and again, I have a short amount of time than maybe I usually would get some more details, which we can certainly do in the questions. I think that come would be a great way to flush out a lot of the information I don't cover. But going to talk about really using IRAs, old 401ks, and we'll talk about the solo K and the QRP as well, and investing in multifamily. Now, the slides I put together, they're kind of look at it one of two ways. And I've included some slides that touch on two different ways, and whether it's your IRA and your 401k, or maybe someone in your family that you want to help them use their retirement accounts to invest on their own. And also from the standpoint for people who might be looking to do their own syndications or raise capital on their own, kind of talking a little bit about that as well, and how the IRAs, how the 401ks dovetail really into what you're doing on your individual basis. So obviously I already introduced myself. I've been with the company. I mentioned we've been around since 2004. I've been with Advanta myself since 2006. Admittedly, knew nothing about self-directed IRAs when I started, and I learned by sitting and watching our owner give various presentations to different groups, sitting and just listening to my colleagues talk to people on the phone and answer questions about self-directed retirement accounts and the different investments that people see. Over time, obviously became somewhat of an expert myself, and obviously learning what self-directed IRAs are and all the rules and laws that go along with that. I'm a licensed attorney by degree. I do some legal work outside of Advanta. I do not do anything for Advanta clients. But here's my contact information on this slide. I'll definitely share it again later as well. As I mentioned, our company's been around for quite a while. We have over $2 billion in assets under management. And we really do focus on the customer service experience, not only for individual account owners, but also certainly our referral partners as well. So for those of you on the call, maybe we'll start at a base level. Those individuals who are not familiar with really what a self-directed IRA is. And if I use the term self-directed IRA, you can also include the self-directed solo 401k, the self-directed QRP in that term as I use it through the presentation. But really, the self-directed name, I've talked to people over the years and say, well, oh, yeah, I have a self-directed IRA with my Morgan Stanley or my Charles Schwab account is self-directed. And that's really, in our opinion, not a truly self-directed account, because within those accounts at a brokerage firm, even if you can choose your mutual funds and you can choose your stocks and the other publicly traded assets, you're still being limited to the assets that brokerage firm or that bank is holding for you or is willing to let you invest in. But there's a whole other universe of investments that we'll touch on tonight that you can make with your retirement account and have that be on a tax advantage basis, investing in those assets using your retirement account. So really a truly self-directed IRA, and how we talk about a self-directed IRA is one in which the IRA owner has complete control over the funds and investing into the asset class they want to invest in, not just investing amongst different options within a specific class. And again, I think that's the big differentiator with a self-directed IRA with a firm like ours and a self-directed IRA that you would find with a brokerage firm, is really being able to find different asset classes that are outside of the more traditional assets you would associate with a stock market, which, as we've seen over the last several weeks, has been on quite the roller coaster. And that makes people uncomfortable. Whether this is your own account that you're uncomfortable watching your IRA and your 401k bounce up and down, or whether it's the investors that you're talking to who want something more consistent, more stable as an investment inside their IRA account. So that's really what a self-directed IRA is. Really, you as the IRA owner have complete control over choosing what type of investment you wish to make within the IRA, when you make it, and obviously how you drive the returns into that account. Over the years, and talking with the thousands of people that I've talked to about self-directed accounts, the motivators really for individuals, they typically fall in one of three buckets. For some individuals, they're choosing to self-direct simply because the retirement account is a new source of capital for them. So they could be, say, someone who invests in single-family homes. Their IRA provides the cash for them to go acquire another home as part of their portfolio rather than going to a bank. Or again, people who invest in multifamily projects. Hey, another deal came along from my favorite provider. Where's my cash? What cash can I use? And they find out they can use their IRA, their 401k funds to actually make that investment. So for some individuals, they've already been investing in alternative assets. They're just finding a different way to do it using their IRA. For some, it's the stock market fatigue, right? As I was just talking about, stock market goes up and down. A lot of people feel, I think correctly, you don't have much control over the stock market. I mean, you can choose different investments. So you could put your money in a money market account and earn negligible interest within the account if you want to really sit it out, but you don't have much control over it. So it makes people uneasy that when gas goes to $5 a gallon nationally, it's nothing I had to do with that. Or things happen, over in Eastern Europe or the Middle East or wherever the case may be, it affects your 401k because you're tied to the stock market. It's going up and down based on those factors. And so individuals want to find investments that they can control that aren't affected by some of those same forces. That's again, really another reason why people choose to self-direct. And there's also the aspect that there are tax benefits. When you invest within an IRA or 401k, a lot of times the income that is generated comes back to your IRA on a tax deferred or possibly tax-free basis. So for those individuals, someone who might be in a higher tax bracket with an investment that's going to produce a lot of income, investing through the IRA might be the better way to go because it's not going to affect their personal tax situation. So these are kind of three of the main motivators that we see. And obviously people can fall into multiple buckets, but that's typically the people we talk to. These are one of the reasons that they're investing. And the fact that the reason why people don't know more about it, as I've alluded to already, is that most IRAs, most 401ks are held with banks and brokerage firms who are going to offer their clients only the products that they sell. They want you to buy their mutual funds, their stocks. That's how they make money. That's how their business is set up to earn money. They are not set up for you to invest in real estate or syndications or even cryptocurrency or private startup companies. That just doesn't fit their business model. So they're not going to let you know that it exists. And I always liken it to you're walking into a fast food restaurant for lunch, they're not going to let you know about the other fast food options that are down the street, right? They want to keep you at their McDonald's so that you order from them and you eat there. So it's kind of a strategy where they're not going to tell you about it. So you do have to either find it on your own, or maybe you come to a seminar like this one, or you talk to another investment provider that lets you know that option even exists. So it's not that it's illegal. If I had financial advisors tell their clients that it's not possible to do this, and they say that because they can't do it on their own platform. So again, they don't want you to know that there's every option. The IRS regulations regarding retirement account investing allow you to invest in a very, very broad range of investments. The regulations just don't require every custodian to hold every asset. So even though you can invest in real estate, Charles Schwab, Fidelity, Morgan Stanley, they do not have to allow it on their platform. But that's kind of where our firm and firms like ours step in, is holding alternative assets that the big boys, the big firms typically don't hold. Obviously, I mentioned real estate probably makes up 70 to 75% of the investments that we hold for our clients. And again, that runs the gamut from single family homes that are used for rental, possibly for fixer-uppers, commercial real estate, condos, duplexes, obviously the multifamily that we're talking about tonight as well, raw land, even beyond the physical real estate. You can lend money from your retirement account to a third party and have the income that generates flow back into your account. So a lot of different things you can do with the real estate. There are some restrictions on what you cannot do if you own a property. We'll get to those in a little bit. The restrictions really, when it comes to investments, you cannot buy life insurance and you cannot buy collectibles. There's the only two prohibited investments that you cannot hold inside of an IRA account. As we talk about, again, self-directed IRAs, or I guess more broadly, self-directed plans, that's the question we get often. Okay, I hear what you're saying, Scott. This sounds good, but what accounts exactly am I able to self-direct inside the retirement plan environment? Simple answer for one is any IRA. So if you have a traditional IRA or you have a Roth IRA, if you're self-employed or work for a small business, you may have a SEP or a simple IRA. Those accounts can, without a doubt, be self-directed. It's just a matter of filling out the paperwork. Doesn't matter if you're still employed with somebody doing a simple or a SEP, you can self-direct those funds. When we get into the qualified plans, the employer plans, any former employer plan, like an old 401k, an old 403b for school employees, 457 for government employees, and the TSP plans for federal government employees. Once you leave that employer, you can take those funds, roll it over into a traditional IRA or maybe even a Roth IRA, and then in turn self-direct it. So again, any IRA, any old employer's plan. For people who are self-employed, and maybe a lot of you on the call fall into this category, there is also, as I think the last speakers were talking about, the QRPs, the qualified retirement plans are also, we call them at our company a solo 401k. It's setting up a 401k plan just for yourself, just for your business. If you don't have any employees, it's a very simple plan that you open up and operate with very little reporting that's required. We can handle part of that reporting for you if you need to, but it's a very straightforward plan. It has some advantages over the IRAs I think we'll talk about as we get some questions in regards to the UBIT tax and things of that nature. So any IRA, any old employer plan, you can set up a solo 401k. About the only accounts that you cannot self-direct, by and large, are your current employer plans. If you are working for a business now, or your investors are working and they're currently employed, they may not be able to touch a 401k where they're currently employed. That's simply a matter of the rules do not require a current employer to make the funds portable out of the account as long as somebody's employed there. So that is the one restriction, unfortunately, that does pop up obviously from time to time. But in this day and age, a lot of people have changed jobs. They have old 401ks. Maybe they've even rolled that 401k already to an IRA, and you can certainly self-direct it. So won't go into detail about the different types of plans. That's kind of maybe for a longer, more in-depth presentation or talking to someone on an individual basis. But the traditional, the SEPs, the simple IRAs, they're all tax deferred, meaning you'll pay tax on the funds once you pull them out in retirement, but you get a tax break up front for making the contribution. The Roth IRA is the kind of gold standard of retirement accounts. It's tax-free growth inside the Roth IRA. So you put money into a Roth IRA, you forego a tax deduction, that money is going to grow tax-free over the course of your lifetime. You can pull it out in retirement, no tax consequence to you. So that's why that money is very prized, very special money. If you have a Roth IRA, you probably know that already. So again, if this presentation is for you as an individual that you're looking, or you're trying to grasp it from the standpoint of your investors, again, a common question we get is, how do I get money moved if I have money in a brokerage firm, in a brokerage IRA, or maybe an old 401k still with a brokerage firm? How do I get that money moved into a position where I can invest it into real estate? And it's typically done one of two ways. It's either done via transfer, which is typically IRA to IRA, or there's the process, if you're going from an old 401k type plan to an IRA, it's called a direct rollover. Both of these processes are tax-free movements of money. With the direct rollover, there's a little bit of reporting that's done on both your former employer's side and our side, but it's tax-free. And you can do transfers and rollovers as often and whenever you'd like between accounts, as long as you don't touch the money. There is no tax, there is no penalty. You can pull money over to Advana, make an investment, and as that investment kicks off a nice return, you can send that money right back to your other custodian at a brokerage firm. So the process takes probably a few days to a few weeks, just depending on where your funds are located. But this is, again, an important thing. Again, I think especially if you're raising capital, let people know that self-directed retirement account, it's not an all or nothing strategy. Again, the transfers, because they can be done in partial amounts, allow someone to only maybe test a portion. If someone has a $200,000 retirement account and they only want to use $50,000 for your real estate syndication, then that's really all they need to transfer to start. So a lot of times that'll put people at ease that they're not making the decision to forego the stock market for the forever. It's merely a means of getting some more diversity within their account. But this is something that are part of the things that we do at Advanta is walking people through the transfer, walking them through the rollover process, and letting them know, obviously, what they need to do each step of the way, what their custodian's going to need, and make sure it happens so there is no tax consequence. So we'll talk again. Now we'll jump in maybe the rules. And the neat thing, in a sense, about self-directed rules is that there aren't a lot of them. Okay, there's not a huge list that you have to go through and check to make sure the investment you're going to make is allowed. Okay, there's no master list of every single possible investment. They simply, when the IRS created the rules for self-directed retirement accounts, simply said there's a couple of investments you can't make, and there's some people that you cannot transact with your IRA, regardless of the investment you're making. So, as I mentioned earlier, the life insurance products and collectibles like antiques and artwork, those are the only two prohibited investments that you cannot make within an IRA account. So again, nowhere in the code does it say you can buy syndications or rental properties or cryptocurrency or startup companies, precious metals, anything like that. It just simply says no life insurance, no collectibles. And so that is fairly straightforward. We don't get a lot of questions day to day on those investments. But the other area that's a little bit more restrictive is the IRS also prohibits retirement plans from transacting with certain disqualified persons. So, the IRA or your 401k cannot transact with somebody who's considered disqualified. The IRA owner or a disqualified person cannot receive any benefit from the assets of the plan itself. So in the context of real estate investing, if you wanted to buy a single family property out on the beach or up in the mountains, it's got to be strictly for investment purposes. You cannot get any personal use out of it, nor can any disqualified person use that property, use that particular asset. If you have a property that you wanted to sell, you cannot sell it to your IRA. Your IRA cannot sell it to you or any disqualified person. So again, sometimes that gets a little bit restrictive. I think in the context of multifamily, we don't see this very much, except for the cases if you're a GP on a deal and you're going to be one of the managers of the particular project, your IRA, some of the people in your family are going to be prohibited from using their IRAs, their 401ks to invest. But outside of that, if you're investing with third parties or you're getting third parties to invest with you, you're not going to run into any issues with these particular rules. Here's just a quick chart of who's disqualified for your retirement account. It includes yourself as the IRA owner, your spouse, any lineal ascendants, so your parents and grandparents, your children and grandchildren are also prohibited individuals. And it does include any entity that is owned or controlled by one of the above. So if you own a property in an LLC and you own that LLC 100%, you can't sell it to your IRA. So there's some rules obviously extending out a little bit, but it's got to be an entity that one of these people own or control. The IRS refers to this really as self-dealing. So if you're ever talking with someone about self-directed IRAs or you hear a presenter like myself use the term self-dealing, this is what we're talking about. Your IRA cannot deal with these individuals. So Again, great thing about the rules, the only things that are prohibited, life insurance and collectibles, and the dealings with the self-dealing with the disqualified persons. Outside of that, again, precious metals, real estate, whatever the case may be, you can make the investment. And in Advanta, we've held some very, very interesting investments over the years. As long as we can document it, we will hold it inside of a self-directed IRA account. And I think, again, this slide might be geared a little bit more to the people who are looking to raise capital, but I think also, obviously, if you are an investor, why retirement funds really make a good capital source. I think for someone raising capital, you can simply go to your existing investor database. If you have not been taking retirement funds up till now, and this is, again, something that's a little bit newer to you, or you're a little scared to get involved in it, you can simply tap into your existing database, tell them how they can use their IRA funds, use their old 401ks for the next project that you have coming up. So it's not necessarily that you have to go out and find a whole new batch of investors who are willing to use their IRA accounts. I think that makes it a little bit easier. And it also certainly gives you it opens a few more doors to the people that you are talking to and giving them a different option. Hopefully you're offering better or more consistent returns, or you're expecting to get better or more consistent returns. Again, with the stock market up and down as it's been lately, some people will end up leaving the market. They will sell off their mutual funds and their stocks, and they'll sit in a cash position waiting for the storm to blow over. And so they may be earning 1 or 2% at most within those accounts with not really sure where to go. You present them, or they find a good opportunity into an investment, for instance, in a multifamily that's going to give a consistent monthly dividend. That's where, again, somebody becomes attractive to, okay, I don't want my money. I know the 1% in a money market is not a long-term strategy, and I don't know when to time getting back in the market. I just don't ever feel safe. You offering them an alternative. There's also no outside approval needed. The IRA owner, the account owner, simply decides to make the decision. So going to a bank to get approval, don't have to get an approval from a financial advisor. It's the IRA account owner themselves pulling the trigger. And again, I think looking at it both from the raising capital source and also if this is your own account, one of the reasons I think retirement funds are so popular, especially in, say, 2, 3, or 5-year hold investments, is that most people who have money in an IRA or a 401k are not expecting to touch that money anytime soon. If they're in their 40s, 50s, even in their 60s, that money is there as a last resort for emergencies. So that money is just sitting there. They don't need the cash from that account in an emergency. That's what they have their emergency. That's what they have their savings accounts for. Loss of job or a medical emergency. They're going to pull cash from those other savings accounts, the non-qualified money first. So locking money up in a 3 to 5 year investment without maybe being able to liquidate it doesn't matter to them because they weren't going to be touching the money for 10, 15, 20 years anyhow. So again, I think when talking with an investor, or again, if you're looking to invest yourself, that's a reason why people look to use their IRA, why they look to use their 401k, because I'm not going to use the money anyway. So if I tie it up for 3 years, it's not going to matter. If I have a medical emergency or temporary loss of job, that's what I have my savings account for. So again, I think that's one of the main reasons, the impetus is why people decide to use their IRA for those types of investments. And maybe they don't need the income now. So with the investors that we deal with, a lot of people fall into 2 categories. There are people who are more active on the real estate side and people who are more passive. Probably not a earth-shattering slide here for a lot of people on the call, but I think it's helpful sometimes if you're not sure what kind of investor you are, to have this kind of analysis with yourself, or certainly the people that you're looking to invest with you, right? So if I'm out raising capital for a multifamily syndication, I'm looking for people who want to be passive. I want people who just want to get set up front and sit back and get a check every month. They don't want to be involved in day-to-day decisions. That's who I'm looking for, right? Because if I get a bunch of active investors, people who want to have more control, my phone's going to be ringing all the time as a GP, and I don't want that. I want to be able to manage the project on my own. And conversely, if you are finding people who are active, then maybe it's helping shoo them into maybe a different type of investment rather than your syndication or multifamily. And if you're somebody who has the IRA cash, you can certainly make all of these investments within your IRA. You can do some active investments, you can do some passive investments, but I think it's a good discussion internally to have as an investor, and then decide ultimately from there, okay, once I've made that decision, with my IRA account, what types of investments should I be looking into? So I did want to go through a quick case study just to illustrate how the process works for someone who's looking to invest their IRA account or 401k, and then we're going to go over kind of investing in a multifamily syndication as the case study itself. We have Jane. She has the money in an IRA account. John is the one who has the offering that he's looking to raise a couple $1 million in capital to purchase and remodel an apartment complex. So with Advanta, our role is going to be with Jane to help her get her account opened, get the funds transferred from Vanguard. Again, it's a tax-free transfer to move from IRA at Vanguard over to the IRA at Advanta. And then ultimately, Jane's responsibility, though, is going to be to provide Advanta with the subscription paperwork or ask John to provide it. And Jane's going to need to do her due diligence on the investment itself. So key thing with self-directed IRA custodians, none of us, at least none of us should be providing any investments. Self-directed custodians and administrators like ourselves, we do not give investment advice. We do not solicit for investments, and we're not going to put an investment deal in front of you and encourage you to make the investment. So it's going to be up to the client and the investor to make that decision that it's to not only find the investment, but then make sure it's acceptable for them. The account manager at Advanta, so after we've helped Jane get her account opened, get her funds transferred, the next phase of the process will be making sure that the investment paperwork, the subscription documents, get completed with the name of her IRA account as the actual subscriber. So you can see on the paperwork, on the subscription agreement, the subscriber's name, the investor's name needs to read Advanta for benefit of Jane Smith's IRA. We use our tax ID number on the documents, not her social, so that all the tax reporting, again, flows back to her IRA, not to her social. Ultimately, she's going to sign the sub-documents to approve them, and then we're ultimately going to wire funds to closing. Going forward, the numbers aren't necessarily important. It's just that the future gains, the quarterly distributions, come back into her account. Any profits at the end of I guess as she exits the deal, all of that does come back into her IRA. And I know with this example, because it's an IRA account, Jane is going to incur something called UBIT tax. And I don't necessarily have a slide on that, but I'll discuss it kind of quickly. And Whitney, did you guys talk about this UBIT a lot on with the prior speakers?
Yeah, so Amanda went through UBIT tax fairly thoroughly. So yeah, no, I was mostly just kind of joking around.
Okay, well, that's good. Well, in that case, I'm not going to bore everyone by doing it again.
Well, there's a couple people that just joined in, so maybe just like a 60-second,
Sure.
primer on it would be great.
Yep. So for those of you just joining and the others, you're getting a little quick refresher. Whenever an IRA invests into a real estate project that has underlying debt or leverage, it subjects the IRA to something called unrelated business income tax. And that tax applies to the IRA account. It is not a tax in this example that Jane would pay. It's a tax that her IRA would pay. And the way UBIT tax works is whatever the percentage of leverage is involved in the underlying deal. So let's say that the property is 60% leveraged, then 60% of the income flowing back to her IRA is subject to this UBIT tax. The other 40% that's based on the equity portion that's involved, that's tax-free, right back to her account. But the other 60% will be subject to UBIT. The IRA does get the benefit to write off some depreciation, some other deductions to limit how much UBIT would apply. Now, contrasting that with what I talked about with you can't invest in life insurance, you can't invest in collectibles, you can't invest in with your disqualified persons. Paying UBIT tax does not make something prohibited. Obviously, it's just going to affect your overall return within your retirement account. So in this case, because Jane used an IRA account, her IRA will be subject to UBIT if the property and the investment itself is leveraged. Just going back to the QRP and the solo 401k account, if Jane was self-employed or had a side business and she could set up a solo 401k plans do not pay UBIT tax on leveraged income. So if you're out there listening to this call and you're self-employed or you have a side business where you can set up a solo K and you want to invest in leveraged real estate deals, then absolutely the solo K, the QRP is the way to go. And the same would be true for any of your investors as well. So the process for an individual investor, kind of went over it in the example a little bit of it. It's filling out the paperwork to open up an account. Takes 15, 20 minutes to fill out that paperwork, funding the account with a transfer or rollover, and then start investing, right? Somebody coming and finding the investment, telling us what you want to purchase. And our role at Advanta will be to manage that process and make sure the investment gets properly titled in the name of your retirement accounts. Again, for those of you who are on the call looking on how we can help you raise capital, again, as I mentioned a minute ago, we cannot sell or endorse any particular investment. Now, we certainly endorse people investing in alternative assets. That's what we do. We encourage people to look and find other investments, but we can't endorse a particular investment or even a particular provider. But what we can do is try to help you educate your current and prospective investors about using their retirement accounts. We do obviously online webinars, like we're doing this one here. We do some of our own events. We can do private events for you and your investors. We have a private landing page and a marketing flyer that we can create for you. We've done that for a number of providers where we will host a private landing page on our site with your logo, your information, telling your clients, hey, you can use your IRA to invest with me. And we can provide you with a flyer. Basically, here's the 5 steps to investing your IRA with ABC Capital. We put your logo on the flyer, and it's something you can use then in email blasts, put it on your website, hand it out to people on a one-on-one basis as well. So that's something we do free of charge. So if that's something you're interested in for your company, definitely let me know. And we do offer something we started during the first few months of COVID to give people a chance to reach out and connect. And we've kept it going because it's been popular. Is we call it Pitch, Promote, and Prosper. It's an event every other Friday. You can come on, you can share your particular deal. Again, we're not going to endorse it, but we'll provide the forum for you to put it out there and say, hey, I'm looking to raise this amount of capital, or I have this asset to sell. So we try to do what we can to stay within the bounds that we don't get ourselves in trouble, but also provide some value to people who are indeed raising capital. So that's kind of the end of my prepared remarks, Whitney. But I am more than happy now. I'm sure we have a couple of questions that came in, and whether you want me to address the QRP in more detail, happy to help.
Well, so we've got several questions here. I'm going to work through them a little bit backwards because I think some of the questions came in really early. These are
Okay.
more of the presentation. Does disqualified persons include children? But do they include grandchildren? And essentially, are grandchildren disqualified?
They are, because it's directly up and down the lineal tree of the IRA owner. So if you're trying to figure out if someone's disqualified, you figure out whose IRA it is, and then it's directly up and down their lineal tree. So it is going to include grandchildren. It does not include brothers and sisters, aunts and uncles, nieces or nephews, but it does include children and grandchildren.
All right. Let's see. Another question. Can you loan funds from your IRA to a non-disqualified party to purchase the property themselves and issue principal and interest payments to your IRA to repay the loan?
Absolutely. And we actually just did a webinar 2 days ago on that. We call it's private lending in an IRA account, where your IRA is the bank, right? Someone's coming to you. They want to buy a property either to rent, to flip, live in, whatever the case may be. Your IRA can stand in the place of the bank and provide that financing to them. And as they make their monthly mortgage payments, instead of sending that money to Bank of America or Wells Fargo, they just send it back to your IRA. And the terms that go into that loan are really whatever the IRA owner and the borrower agree on. So Advanta does not get involved in determining the interest rate, the other terms of the loan. That's going to be up to you and your borrower.
Awesome. Can one person have more than one IRA of the same type?
Absolutely. And then getting back to the transfer issue. Again, if someone has a traditional IRA, let's say at Charles Schwab, they can open up a traditional IRA at Advanta, transfer whatever amount they wish from the Schwab account to Advanta, and then make the investments. The only thing you're limited to with your IRA accounts is the IRS puts restrictions on how much you can contribute out of your pocket each year to the account. As new contributions. Now, there is no limitation on earnings. I want to make sure that that's clear. So if your IRA is pumping out 10 or 20 grand worth of income every year or more, there's no restriction on that. But the restriction is on you making a new contribution to your IRAs. And for example, for a traditional IRA, your max contribution out of pocket is $6,000 a year, or $7,000 if you're over 50. And that amount does apply across the different IRAs that you have. So if I had a Schwab and an Advanta IRA, I cannot contribute a total of more than $6,000 to those accounts.
So follow-up question to that. What's the catch-up provision? What are the rules around catch-up? Like if you started your IRA later?
Yeah, so the catch-up provisions apply to, it's the traditional and the Roth, I think the simple IRA, and also the 401ks or solo Ks. Essentially, the IRS is once someone hits age 50, they will allow you to contribute an additional amount each year into the plan. They, like I said, they call it a catch-up contribution. So for traditional and Roth IRAs, you can put in an additional $1,000. So instead of a $6,000 contribution, you're making a $7,000 contribution. For simple IRAs, I think the catch-up contribution is around $3,000 or $3,500. And with the 401ks, you can actually contribute as the employee involved in the 401k. I think the catch-up provision is $6,500 a year extra once you're over the age of 50. So yeah, if you're getting started a little bit later, or even if you've been saving even if you've been putting your IRA, put money in your IRA since age 20, even when you hit 50, you can add more to it with those catch-up contributions.
Awesome. Does life insurance prohibition mean you cannot invest in a syndication investing in life insurance settlements?
Yeah, I mean, that's I can be honest, that's Advance's take on it, that it's still a life insurance product. I could probably, like I said, I'm an attorney, so I'm good at making arguments sometimes. I could probably try to make an argument that it's not prohibited because you're not investing in life insurance, you're investing in a private partnership, right? And so you're maybe splitting hairs a little bit. And that's kind of the position we take at Advanta. That even if you say, hey, I'm investing in a partnership and as a limited partner, I'm not investing in life insurance per se. That even if that's the primary investment within the LP or within the LLC itself, that we consider that to be prohibited. In fact, we've had a couple people recently ask about that. We said, hey, it's just not something you want to do. I mean, if you came to us and said, I want to invest in ABC LLC, and we may have no idea that it's invested in life insurance. And we may process the investment because we don't know that. But if you tell us that, we're certainly going to counsel you away from doing it.
All right, next question. Can I roll an old 401k into a solo 401k? What if I don't have my own business?
So the answer to the first part of the question without the second kind of qualifier to it, yes, you can roll an old 401k into a solo K. The solo 401ks can also take transfers or rollovers from traditional IRAs, from SEP IRAs, and from simple IRAs. The only money that you cannot roll into a solo K are funds that are in a Roth IRA. And that's just a weird function of how the rules work that you can't do that. Now, the other part of the qualifying question, though, I think is really important for people looking to do a solo K, and it comes up a lot with the individuals who are trying to obviously avoid UBIT, is that with a 401k, the IRS does expect you, if you're going to start a solo K, that you either have a business, either that's you're self-employed, or you at least have a side business that produces some earned income, and they expect that that there's kind of a sponsoring entity. It doesn't have to be, again, it could just be you could do 5 hours of consulting a week or something very, very low key like that, in addition to your W-2 job, and that can serve as the basis for the 401k, the solo K. But the IRS does expect you have that side business or a primary business, and you do have income, earned income from that business at times, and that you also make contributions from your earned income from your business into the solo K. So they definitely frown upon people setting up a solo K without really having a valid sponsoring business, just to avoid UBIT. And I know that I've seen some people try to do that. I mean, we counsel people up front what they're supposed to do. What they do from there going forward is sometimes out of our control. But you do want to make a contribution. Otherwise, the IRS looks at it as kind of a shelf solo K. The genesis, the reason why people set up retirement accounts is to save for retirement and defer some of their earnings. And if you're not doing the deferment of earnings, you risk the IRS looking at it and saying, you know what, this really isn't a 401k account. Therefore, you lost any protections, tax or otherwise, that it might usually provide.
Will there be any legal changes regarding the QRP 401k plans?
I don't know. I mean, I haven't seen anything. There is a couple years ago, in kind of a rare moment with our government, there was the Secure Act that was passed. Actually, it was quite a lot of bipartisan support that raised the required distribution level, made some changes to the contributions. There is a Secure Act 2.0 that actually passed the House with, I think, like 417 to 5, which again is completely unheard of in our era. But That's coming along. That's going to make some changes to the required minimum distribution age, which for those of you who aren't familiar, if you have an IRA that's not a Roth, once you hit age 72, you have to start taking distributions. The new law is going to make some changes to that age across all retirement accounts. I think they're going to change some of the catch-up contribution rules, allow for people to auto-enroll more easily into these accounts, but I haven't heard anything specifically on the QRPs or solo Ks other than those kind of broader changes just in general to the IRAs and 401ks.
All right. And we just have a few minutes left. Question, I know, and Scott, we've done so many events together over the past few months. The monkey in the room. I know there's a lot of confusion out there around checkbook LLCs, checkbook IRAs. For one, are they still legal? And two, what are the pros and cons?
So yeah, and just the quick backstory, checkbook LLC is I guess we'll take you one more step back. With the example that I showed in the case study with Jane and John, Advanta as the IRA administrator would hold that investment inside the IRA. We would receive the income. If you were to buy a rental property inside the IRA, we receive all the rent income, we pay all the expenses. And so we actually, in a sense, hold control over the funds and you make the direction of what to do. The checkbook LLC or the checkbook IRA is a mechanism where you form a new LLC. You direct us, instead of buying the real estate, to put all the cash into an LLC that you are the manager of and that your IRA is the sole member. And then from there, you make the investments as the manager of the LLC. So you buy the real estate, you receive the rents, you pay the bills, all out of that structure. And it's been around for a while. There was a case in 1996 that kind of legitimized it called Swanson v. Commissioner. It was actually then upheld again, I think in 2013 with another tax court decision to say the structure itself is not problematic. If it's a brand new LLC, then your IRA can own it and you can manage it as long as you're not being compensated. What happened recently was a case of McNulty v. Commissioner, where somebody took the LLC structure and decided that they were going to buy precious metals with their LLC. And since they were the manager of the LLC, they could just hold the gold and silver at home in their own safe. And that is something that we would have told people you can't do. The IRS even said on their own website, you shouldn't do it. That using an LLC to circumvent that rule is problematic. So I think it's important to note that that case was talking specifically about the dominion and control that the IRA owner had on the precious metals within the account. Again, with real estate, you can't hold that at home. I mean, you can administer it, you can sign deeds, but I don't think that those assets at all rise to the level as what the precious metals and that direct control that they would have to have. So I think the checkbook LLC is still very much alive and well, but you need to make sure that you're not violating any of the other rules. And again, the IRS does not allow you to personally hold precious metals if you own them through your IRA. You have to have a third party, like a depository institution, holding them. So that's where that taxpayer went awry. And I don't read anything more into the decision other than them kind of confirming already what was known to a lot of us.
Awesome. Okay, and so just real quick, the pros and cons of a checkbook LLC. And this will probably be our last question.
Yeah, so the pros, you have more control. So if you're, for instance, wanting to buy property at auctions, you can go to the auction house and you can issue the check, you can issue the wire directly out of your account without having to come back to Advanta, fill out paperwork to do that. So you have a lot more control over your investments. If you're looking to do a lot of different investments, you're only going to pay us one fee a year to hold the LLC for you. So instead of paying maybe 2 or 3 different fees for the 2 or 3 different assets, holding them through an LLC reduces the fees to us. Now the cons, the rules that I talked about with the disqualified persons, you could inadvertently, unintentionally make a loan from your LLC to your daughter just because, hey, the money's here, I'll just give her a quick loan from my IRA LLC, and not realize or forget that you just violated the rules. If you'd come to Advanta and said, I want to loan money from my IRA to my daughter, we'd say you can't do that. So the cons of the LLC are kind of the antithesis of the benefit, right? You have a great deal of control, which is great, but you have to make sure that you use it properly. That's the area where people can get in trouble, is really in managing the LLC and making sure they don't do something that's prohibited.
All right, guys. You guys had so many wonderful questions. We actually got through all but 2 that were very personal situation related. I am going to encourage you, Scott just put his contact information up again, reach out to him directly. I was about to ask Scott, where can they find you?
Yeah, no, that's a perfect answer, Whitney. If you have kind of your individual situation, that requires a phone call to me so we can go over your specific instance. I mean, what we present on our webinars is much more general.
Awesome. Well, Scott, thank you so much for joining us tonight. This was action-packed and very wonderful. Guys, take advantage of the self-directed IRA. I mean, it is a very powerful tool. It is written into the tax code for us to take advantage of. And, if you're looking for a provider, looking for a partner, I encourage you to reach out to Scott and add Advanta IRA. Scott, again,
thanks,
thank
Whitney.
you so much. Yes.
Thank you very much. I enjoyed it.
Yeah. All right, guys.
Have a good one.
Yeah, we got top of the hour, 6 o'clock. We have our last 2 presenters on, but before we do that, let's stand up and stretch. And I'm mostly talking to me because I need to switch chairs. So I didn't want it to look completely goofy, but go ahead and stand up, grab a quick drink of water, and let's settle in for our last round of presenters. I wanted to bring on Chris Larson with Next Level Income and Blake Brogan with Money Insights. And they are going to talk to us about cash flow life insurance and how you can use that to amplify your returns investing. Now, I'm a little partial, I love investing in real estate, and I know I've heard both of these gentlemen speak, and they have some wonderful examples on how utilizing a very specific type, very specifically structured form of whole life insurance can be very powerful. So this isn't something you're going to get at State Farm, your friend that's doing life insurance. This is very specifically structured. So guys, thank you so much for joining us tonight. I know it's super late where you are, Chris. I really appreciate you for hanging in there with us and joining us. Guys, we're going to go ahead and kick it off. If you have a question, be sure to go over to the Q&A box, drop in your question, and guys, I'll let you do your presentation, and then we'll open it up for Q&A.
Terrific, Whitney. Thank you so much. Tonight, Blake and I are going to be talking about the investment optimizer, and let me make sure I get this shared with everybody here. You may be hearing my dog in the background. So
that's okay. They had to listen to mine a little bit ago when the UPS guy came.
Yeah. Can you guys see that? It doesn't look like it's showing up on here.
There it is. Yay.
Can I get a thumbs up? All right, terrific. Very good. Very good. All right. So, all right. Yeah. So look, 10 years ago, oh geez, more than that now. My son is now 12 years old. My wife told me that she was pregnant, and she surprised me. She showed me like the pregnancy test there on the bed. And my first question for her, can we still go to Europe? Because we had this trip planned to Europe that we planned for over a year. Yeah, that was my first question. But we had this big trip planned, and I thought, I'm doing the math in my head. I'm thinking, man, my son's going to be like 3.5, 4 months old. Like, is that too young? So the answer to that question was yes. And we had a wonderful trip. But the second question that popped in my head was, how am I going to pay for all these things, all these opportunities to provide to my son, from a financial perspective? And one of those things was thinking about college. Do I do a 529 plan? What do I do? And I did a bunch of research, and what I came upon was a strategy using whole life insurance. And that may sound a little odd to some people, but that's what I use. So we start these life insurance policies, and I'm a real estate investor. And 3, 4, 5 years into these policies, we start building spec homes, we start investing in syndications. And I'm telling my insurance agent during our yearly review what I'm doing. He said, Chris, I wish more of my clients would do what you're doing. And I was like, I'm feeling pretty good about myself. And then I hung and thought, why didn't he tell me about this? Why didn't he tell me how to do this? I kept educating myself. And the strategy that we developed and that we use today is what we call the investment optimizer. And we're going to share another layer of profitability that you can add to your investments. So if you are, if you're investing today in syndications or doing any sort of investment at all, or let's say you have an emergency fund that you have in the bank, the government says officially that CPI is about 8.5%. Now, who believes that? I do not believe that. I think it's probably more like 10 or 15%. We may have a bear running around outside. We saw some bears running through yesterday. If you still hear my dog, it's a big bear, about 400 pounds. That means if you have $100,000 sitting in the bank, you're losing $700 to $1,500 a month, somewhere in that range, if you have money sitting in the bank. In the third chapter of my book, which you can get on our website at nextlevelincome.com, I'll send you a copy for free if you'd like. I talk about my opportunity fund. Your opportunity fund should be liquid. It should be safe. I mean, what's more safe than a bank account, right? You have FDIC insurance. We'll talk about that. You want growth. You know, I think I looked at I got my interest on my bank account this past month. It was like 70 cents. It's like totally insignificant, right? Ideally, you get tax benefits. You get to create a benefit in multiple places at the same time. So what are your opportunities for this? Or what are your options for your opportunity fund, as I like to call it? You can use a savings or checking account. You can use a money market account, which is a little bit better, or you can use what we're going to call the investment optimizer. And the reason I have Blake on tonight is he's going to talk about the specifics about the investment optimizer versus a savings account.
That's great, Chris. And you know, before people implement the strategy, if you're a syndication or cash flow investor in any way, what typically happens is you're building up money in your checking savings account. As an opportunity comes, you liquidate that capital, put it into the opportunity, and then it kicks off cash flow and just goes right back in the bank account. That's typically how people are flowing money in and out of their deals right now. So what we wanted just to start off with is some numbers, look at using an investment optimizer as your opportunity fund versus what people are typically doing right now, which is just using savings accounts. So we made some assumptions. We said you're putting in $100,000 a year for 5 years that you're going to use to capitalize this opportunity fund. The first investment that we're going to make is into a syndication. As that kicks off cash flow, we build that account back up. We're subsequently going to start purchasing real estate, cash flowing assets, and we're going to use typical leverage, you know, maybe 80% down from a lender, 80% from the lender, 20% down coming out of our pocket. And we had to make some assumptions of investments. So we said 15% that you can make on an investment and 5% on the appreciation of the properties. Now, when people see that, some people say, man, I wouldn't do a deal for 15%. Others say, I would love to get 15%. Yeah. So regardless of where you are on that spectrum, you know, we just had to use a side-by-side comparison of what we're doing here. So Chris, do you want to kind of pop to the next screen there? So this is our person A, kind of person B side-by-side comparison. So if we kind of fast forward to the end, the net difference that we're able to create is an additional $2 million of value by doing the exact same type of investing using the investment optimizer strategy versus, again, what people are typically using, which is the savings account. Now, how exactly did we get there? Well, you know, we'll talk a little bit about the vehicle and some of the things that are associated with it here in a minute. But one of the first things that you should be noticing is that right away, if we use our savings account, we got 100K saved up, we can obviously deploy that full $100,000 into an investment. If we use the investment optimizer, there is some opportunity cost up front. So in year one, we're only able to put $74,000 into a syndication. Now, if we fast forward to year 10, we have 2.8 that we're putting into an investment here using the investment optimizer versus 2.5. So over just the course of 5 to 10 years, we're able to create more growth inside an investment optimizer policy than we would have by using a bank account. Then after that, the numbers just keep getting larger. So it's going to allow us over the course of 20 years to just continue to invest more and more than we would have had we not used a different strategy. Now, before we go on, you know, the person using the savings account was able to take $500,000, $100,000 a year times 5 years and turn that into $20 million, $20.3 million. So there's some significant wealth building happening. So we are not at all saying, you know, this strategy is going to be your wealth building, your wealth creation strategy. This is really just used to supplement what you are already doing and create a little more value. So an additional 10% value doing the exact same investing, flowing the money in the same way, just kind of layering on the strategy to what you're already doing. So let's take a look at the vehicle that we talked about here on this next one. So we use this term specifically, Whitney. You teed it up well to say that this is not life insurance that you're buying from maybe your brother-in-law. I think you said State Farm, right? So what exactly are we talking about here? No offense to State Farm, if there's any State Farm agents out here, but we're using max overfunded dividend-paying whole life insurance. Every time I say that, I feel like it gets a little bit longer. So what exactly is this max overfunded dividend paying whole life? Well, when we think of insurance, typically what we think of is protection, right? Home, auto, life insurance. You want the protection. You want to pay the least amount you can. This is really the exact opposite. So in whole life insurance, it builds cash value, and then there's a death benefit protection piece on it as well. So what we're doing with these policies is we're actually trying to get the least amount of death benefit. So we want to minimize the cost as much as possible, and we're maximizing the cash value growth. So why would we use a life insurance policy in this way? Well, when you set it up for this max return, low cost, we're able to generate right up to about a 5% rate of return. Now, it can depend a little bit based upon your age and health, but overall, we're getting a 5% rate of return, and additionally, that's a tax-free benefit. So can be some fairly significant growth, but if someone sees that and they're saying, 5% tax-free, couldn't I earn a lot more in my investing? Yeah, hopefully you can do more than that. This is, again, replacing where you're storing your money in between your deals. So, we can create some pretty significant benefit there. Now, additionally, it's safe and predictable. Chris, when you were talking about having an opportunity fund, we need to know that that money's going to be there. You could use a stock market, but obviously there's volatility. We don't know that that's the case. The companies that issue these policies have been able to create predictable growth for literally pushing on 200 years now. And then, of course, this money has to be liquid. So all the money in these policies are liquid and accessible whenever you need access to it. Additionally, we mentioned here the death benefit. So the death benefit comes along with this policy. Ironically, I'm saying we're trying to minimize it as much as possible, but it does become a pretty significant benefit. And that's something that you just don't have to pay for in any other way. If something were to happen to you, there is quite a bit of benefit there. And then in my opinion, the fun part about this strategy happens with the loan provision. And this is what allows us to take all the money out tax-free. And then one of the points you were mentioning, Chris, is we're able to create value in multiple places at the same time. So we'll kind of jump into exactly how that works here. Okay, so here's the strategy. We got the account, which is these special design whole life insurance policies. What exactly are we doing? We're taking capital and we're funding this bucket here. So we're taking our money, putting it in our opportunity fund. Now we mentioned it grows by, right up to about 5%. Well, how exactly does that happen? Two ways. The first is the companies offer a guaranteed interest rate. So that can vary somewhere between 2 to maybe 3 3/4 right now. A lot of the companies settle in at about 3%. But what's really important about that is that we have this guaranteed growth. So it's not volatile. When you have cash value, you can never lose it. And then additionally, the companies that we do business with, set these policies up with, the owners of the policies are actually the owners of the company. So as the company is profitable every single year, they distribute annual dividends to the policy holder. So when we include the guaranteed portion plus the dividend and subtracting the cost, we're right at about a 5% growth. Okay, so again, the fun part now, Chris, if you want to go into the one more. So you have this capital and you're funding your opportunity fund here. Now we got this money whenever we want to invest. We don't actually withdraw the funds from our opportunity fund. What we get access to, this is kind of the key to the strategy, this much bigger bucket of money, which just represents the general account of the insurance company. So we never actually take money out of our policy. We get access to the general account of the insurance company up to the amount of cash value. So the cash value serving as collateral. Let's say we want to go make an investment. Well, the optimal way to do this is to take a loan from the general account of the insurance company and then plug that right into our cash flowing asset, in this case, real estate. So we take the loan, put it in the real estate. As that real estate kicks off cash flow, we use that cash flow very literally to repay the loan that we took. But strategically, as we repay that loan, We just have more money in our bucket to go out and create this cycle over and over again. So there's velocity of money happening. Two very separate buckets of money. That line coming down there is key because what it allows us to do as we're flowing money from the loan side and in doing our investment, we never removed money from the opportunity fund, which means our money stayed in that policy growing and compounding at the exact same time that we were loaning against it to go make our deals. So very literally, as opposed to just having your money in the bank account or in the investment, earning whatever rate of return you have in your investment, by flowing it through this strategy, we capture that growth and we can leverage that to go do the deals that we were already going to do anyway. So very literally, you're just adding a layer of profitability. You have dollars working for you, the exact same dollars working for you in two places at the same time here. So why do we leverage? What are the key benefits here? Well, we're creating tax-free growth and we're able to create value in multiple places at the same time, which I just touched on. But then really, let's get down to some math here. The arbitrage between what we're earning on the growth side versus what we're paying on the loan side. And the way that we're doing this is by earning, compounding, and paying simple. I think, we probably generally understand that compound can grow more than simple interest, but we want to put some actual numbers behind why this is so powerful. So our money remains growing in the compounding thing. So let's say we want to take $100,000 to go invest. And we can choose to repay that loan. That's one of the unique parts about this strategy is you can choose to repay that loan really whenever you want. So in this case, we're just going to represent a 20-year payback schedule. So we're going to pay $8,000 a year on that $100,000 loan balance. After 20 years, that loan gets repaid. If we scroll down kind of to the end, the interest charged is going to be $60,000, just over $60,000, $60,485. Now that is profit to the insurance company. So you borrowed their money and you paid them back interest. And this is some people are like, why would I do that? Why would I pay $60,000 where if I'm just using my bank account, I don't have to pay any interest, right? Well, the benefit to us is our money remained in that policy growing and compounding. So on the loan rate, we were talking about a 5% loan to take that loan from the insurance company. On the compounding side, we're earning the exact same 5%. So on the surface, it's a wash. However, because of the type of interest that we're earning versus what we're paying, we turn that $100,000 into $265,000. So we have an additional $165,000 that we were able to capture on the compounding side versus what we were paying on the loan side. So when we kind of put those numbers side by side, what that gives us is 165 on the compound and the 60,000 on the simple. So simply by flowing the money through the strategy, capturing the benefits, leveraging the policy to go do the investing that you were already going to do anyways, just in this one sample, that's an additional $105,000 that you were able to create that you wouldn't have, had you just been using the bank account here. So on this next slide here, we're going to get into Chris's, I'll kind of tee you up. This is something that you like to talk about, which is how we take this thing really even to the next level.
Yeah. So, well, first off, I work for State Farm, Whitney. And when I heard about this strategy, the first thing I did, this is 20 years ago, but I called my State Farm agent and I said, hey, can we do this? And he said, no, you can't do that. Sorry. So to be fair, and this past week, I actually had a State Farm agent call me and say, hey, how do you do this? Talking about the investment side of things. But I also have an MBA in portfolio management. One of the things we learned while I was doing that MBA was about the concept of arbitrage, which is we just talked about. So, if you're working on Wall Street, they talk about basis points, which is 1/100th of a percentage point. Okay. And if you, over long periods of time, if you can get an extra 100 basis points, which is 1%, that's a big deal. So what Blake's talking about is how do you create millions of dollars of value by adding these small percentages. And over the past year, I had another one of these light bulb moments where I learned that you can actually use a line of credit. And one of the analogies I love to use is how real estate and life insurance are very similar, because life insurance is much like owning a home. You pay the mortgage down, as Blake was showing, you pay this simple interest and you get compounding. So think about it this way. If you have a home that you paid $500,000 for, and you pay off that mortgage over 30 years, $500,000, but it continues to grow at a 5% rate of return, it does not care what the loan balance is. So as your loan balance goes down and you owe less and pay less interest, you're making more money. And that's the exact same concept. So what if we could lower the cost of funds? And that's what you can do when you use a cash value line of credit. And this is what my wife and I have employed here over the last year. Last year, we added 2 more policies to our strategy. And what we get is, 1, we get a better interest rate on the loan. 2, the cash value grows the same, but actually that line that Blake had there in between the small bucket and the big bucket earlier is even more clear, because you don't even go near your policies. It's also very simple, because when I use my line of credit, it's 1 line of credit, even though we have 4 policies that are feeding into that. So it's very simple, it's very smooth, and that simple interest I'm paying is now being paid down on a monthly basis. So I love it, absolutely love it. And when I wire funds, they don't charge me for it. I fill out a simple form. I do it electronically. I get 1 phone call confirming all the information, and the funds are done. It's a lot easier than using Wells Fargo. But you can check on banks. Some banks out there have these lines of credit that you can use for your cash value life insurance. We have several banks that we work with. I can tell you the ones that I work with as well. And the nice thing is, so the life insurance company wants to lend money out. Life insurance company, these mutual insurance, need to make money on the excess funds that they have. They would prefer to lend them to their policyholders. Why would they want to do that? They know them. Who do they know better than their policyholders, that they have all this financial and health information on, history of payment, all of these things? They would much rather that you or their collateral, literally you and your life are their collateral on these loans. It's wonderful. But I get about a 200 basis point difference, 2% lower interest rate with my line of credit, but I can switch that on and off at any time, which is absolutely great. So I get to have my cake and eat it too here. So I'm going to turn this back over to Blake, but this is the same strategy using compound versus simple interest. Before, we talked about $165,000 compounded rate when we're using a 5% rate of return over those 20 years. But check this out, Blake.
So on the simple side, by plugging in Chris's favorite strategy, and frankly, a lot of our clients are utilizing this now just because the numbers just make so much sense to do it this way. But by plugging in that cash value line of credit, Chris, you mentioned about a 200 basis points. So we can get those down to about as low as 3%. So before, we were earning 5 and paying 5, and yet we still had that $105,000 difference. We're just making it more profitable by obviously getting a lower interest rate. So when we kind of plug in our person A, person B side-by-side comparison here, you know, if you remember, we created an additional $2 million of benefit by utilizing this versus doing the same investing with our savings account. When we plug in the cash value line of credit, we jump that to an over 50% difference. So as opposed to $2 million, we have $3.1 million of net difference by utilizing this investment optimizer, in addition with the cash value line of credit, which again are becoming very popular now, versus the bank account. So I know we have maybe one more slide here, just kind of wrapping up some of the key takeaways. You know, first and foremost, the purpose of the strategy is, of course, just to plug in to the investing that you're already doing. We're not trying to change anything. All we're trying to do is flow money in a more profitable way. By utilizing the strategy, we're able to create some tax-free growth that's safe and predictable. Now, a couple things we didn't mention here is the creditor protection, especially for high income earners. You know, this is monitored state to state, but for nearly all states, there's incredible creditor protection on the cash value that's in your policy, which is very important to some. And then the phase 2 we talk about is the tax-free retirement income. Because what's often happening is, as you're building up cash value, you know, people will say all the time, well, I don't want this death benefit, or I don't need this, I don't need the insurance portion. Well, what you can do is take that cash value and turn it into a supplemental kind of tax-free retirement income stream. So by utilizing the strategy, you're already just building up another bucket that you can use during retirement, and it's actually a pretty efficient kind of retirement income supplement. So that is what we had for this presentation here.
Yeah, and look, I'll just top that off. My wife and I use this as a retirement strategy, but I'm a little biased. My father died when I was 5 years old. He was age 41. My best friend called me one day and said, "Hey, what do you do?" And I explained this strategy to him. He's like, I think I'm going to do that for me and my wife." So he starts these policies, and he's thinking about this financial plan. And a lot of people say, "Yeah, Chris, I can get a better interest rate. This isn't the best investment." 3 years later, his wife passes away. She dies, leaves him, their 2 young girls there, and he got a $3 million death benefit when she passed away. If you said, "Hey, what's your rate of return on that?" His answer to that question would probably not be nice, because he didn't view it as a investment. This is a tool. If you need life insurance, this is something you should take a look at and see if it's a good fit for you. If you don't need life insurance, then this may not be a good fit for you. So again, this is the investment optimizer is a tool. If it fits your needs, that can be optimized to be used in conjunction with your benefits. With your investments. It's something that I use personally. I work with Money Insights, and I work with Blake a lot. This is our second presentation this week, right, Blake? So if anybody has any questions and wants to go through any specifics, if we have time, Whitney, Blake and I'd be happy to answer those. I just put my information in the chat here, and you're welcome to reach out to me directly or check out more information on our website as well.
Yeah, absolutely. You guys populate the Q&A box with questions. I'll be happy to moderate. A couple have come in. We just got done talking to Scott with Advanta IRA. He said, you can't invest in whole life insurance with an IRA. So the question is, I'm guessing you couldn't use this vehicle in conjunction with a retirement plan, correct?
So there might be ways to do it. However, you wouldn't want to do it that way. So really the way that the money grows is very much like a Roth IRA. So you do want to put in after-tax dollars. The money then grows technically tax deferred, and you can access it tax-free when you take it out via a loan. So people ask us all the time, "Hey, could I get a tax deduction essentially to put money in there?" There might be ways to do it. However, it makes everything taxable on the way out. So that's not something that you really would ever be in your favor to do. So from a tax perspective, after tax in.
Yeah, I like to call it like a rich people's Roth, because you're putting in after-tax dollars, but the money grows tax-free. And then, as Blake said, I mean, we won't go into all the specifics, but it's kind of like real estate. If you're paying tax on your real estate, income, because you're probably not setting it up right, it's the same way. If you're paying taxes on the income you're getting from your life insurance, you're probably not taking all the advantages. There's a lot of different ways, like Blake was saying, by taking a loan out, that you can get income without paying tax from these types of contracts and policies.
I see what you're saying. Excuse me.
Again, there's another comparison to the real estate as well. So.
Right. Another question came in, is this the type of insurance account that uses a slider? If so, how does it come into play?
I'm not familiar with that term, slider.
Frenchie, is that, are you talking about kind of like a sliding variable rate of return? Is that what you're referring to?
Yeah, Frenchie, if you can give us a little bit more kind of color around your question, that'd be great. And we will come back to it. Yeah. I've got some questions of my own. Yeah. I've got a question for a friend. So you guys talked about the line of credit that can be used. And so, really there's 2 different options, just to recap it for people. From what I heard, you put the money into the policy, you can either go directly to the insurance company and get a loan from them, or you could go and, secure a line of credit at a bank, and they can consolidate all these policies together. So it's easier to manage. Now, my question is, we're heading into perhaps a recession environment, and, lines of credit have been called. Can this type of line of credit be called?
The answer to that is no, and it has to do with the asset that's backing up the collateral, and that's why that's the guaranteed growth portion of this. So, because we have the guaranteed growth, then that they know that the cash value is growing each and every year. So it's perfect collateral for the bank, which is why we're able to get such favorable rates on what we're doing. Yeah,
and it's it is as somebody that went through the last recession and had my lines of credit called, like, this is, when you look at the additional benefits, again, saying like, hey, if you don't need insurance, but the death benefit, the creditor protection, the security behind this, all these things are, it's like, how much are those things worth? We're just kind of talking about the financial piece. These are like all these added benefits. And Frenchie, I know you just put in the chat here, the amount paid into the account, the amount paid to the insurance company. And Blake, you can elaborate on this. But the nice thing is, so you have a range and you have the ability to set the minimum. So typically you have a minimum amount that needs to sustain the policy for a minimum amount of time. And then you have a max on that account that you could put in. And the way we structure these policies is we minimize the cost of the insurance, but we structure it around the amount of cash that you want to put in. And then you can put it in anywhere within that range. And then again, you can go into the specifics here, but there's a point where these policies become self-sustaining as well, and you theoretically don't ever have to contribute to them again.
Yeah, and I think because we use that term maxed overfunded, there are like some IRS regulations that we're dealing with funding these policies in order to keep all the tax benefits. So it's not like you can just put $100,000 in and have $5 of insurance. There's some limits that the IRS puts on it. So yes, exactly what Chris said. There's a large funding range, and so there's a ton of flexibility in terms of how much you fund the policy every year. And then when it says amount paid to the insurance company, we minimize that as absolutely much as possible, and we maximize the part of the policy that's going to go towards building cash value the quickest, as well as give us some nice long-term growth as well.
So
yeah, if you want to get, I'm sorry.
No, go for it, Chris.
Well, I was going to say, you can get really technical with these. So when you combine it with the line of credit, you can really get efficient. I can say creative, but it's really efficient. Whereas you can move money into and out of the line of credit in a very efficient manner. You can even pay your premiums with your line of credit, depending on your comfort level with that. So you can really combine the two, Frenchie, and you can. I say you basically eliminate any liquidity drag. So you're never. Look, right now I'm paying 3.25% of an interest rate, and I'm getting over 5% of my policies. Why would I not? Why would I not put money in and borrow it right back out? I'm immediately earning, like almost 2% doing that. So you have to consider your own situation, your cash flow, and make sure you're responsible with that. You don't want to go like buy a boat, for instance, with this necessarily. We like to talk about using it responsibly with cash flow investments or business interests, those sorts of things.
So Chris, you've already put in your information in the chat box. Guys, I know a lot of people, it's late on the East Coast. Thank you so much for hanging out with us. If you're, make sure you snag Chris's information before you leave. But I did have another question. You mentioned that this is kind of the rich man's Roth account. Can you go into a little bit more about exactly what you meant by that?
You want to kind of tag team this again? We can.
Yeah.
So, all right. Yeah. So
my
wife
really,
and I,
the reason is
you're gonna add more than you're gonna add more value than I say. So so my wife and I are both business owners. We're both entrepreneurs now. We don't have 401ks. We don't have any matching. We don't have any of that. Okay. And we make too much money to contribute to a Roth IRA. So we can contribute after tax dollars to these plans. We have a guaranteed amount of cash value of growth that's in these. And then the cool thing is we can take the cash value out and invest them in, we could theoretically invest in the stock market if we wanted to with these. And then we can cycle that money back in, as Blake was showing on the diagram, and we can create values that increase over a period of time. And then we actually can then take that money out tax-free on the back end, because it's after tax dollars, tax-free because it's properly structured. So again, just like a Roth, you could put money in post-tax, it can accumulate in a tax-deferred basis, and then we can pull it out after tax. And you actually have more flexibility in a Roth, because we can do really anything with that cash that we want. And the nice thing is there's a lot of protection from creditors. There's a lot of privacy around it as well.
And I think just the last thing I'd add to that is there's no funding limits to these. So you can fund them as much as you want, where a Roth IRA might have a certain funding limit. And if you make over a certain amount, you can't even contribute into that at all. So for those who are looking for tax advantage growth of their money, life insurance provides a way that you can do that on a pretty large scale.
Awesome. Perfect explanation. That's exactly what I was going for. This is a great alternative for people who, or if you're fortunate enough to be in that situation, to be able to still take advantage of a tax advantaged account. Guys, I know it's late. If you guys have any other questions, now's the time to drop them in the chat box. Do you guys have other common questions that investors ask about this that we didn't cover?
Yeah, a question that I ask all the time is, what if I'm uninsurable? So if you're someone who's had a health issue or, for whatever reason can't get insurance, does this strategy still work? And the answer is most likely yes, because you can be the owner on policies with you not as the insured. So it could be a spouse is very common, a business owner is very common. So if you're someone who's maybe older, you're in your mid 70s or upper 70s, you're like, I still want to do this strategy, but it might not work on myself because insurance costs are so high. You can always use someone else. So that's the common question. Chris, do you have other common questions that get asked to you?
Yeah, I hear, hey, I can get a better rate of return, or I should, I can buy term and invest the difference and do that. And look, if you are take time tonight to learn about these strategies, you're not listening to Dave Ramsey and doing what Dave Ramsey says. Dave Ramsey has advice, upset some people here, for poor people. And look, if you're not accredited, you're probably living paycheck to paycheck. I have friends that are making $500,000 a year that live paycheck to paycheck, live in California, and it blows my mind. But if you want to create generational wealth, the ultra rich use strategies like real estate, like cash flow life insurance, like creating businesses. And they may have 401ks, but they're not generating their wealth through 401ks. So over the last 20 years, I've spent time studying and figuring out what the ultra rich do. And this strategy keeps popping up. And what's amazing is when you start to use these strategies, creating wealth, not only during your life, like we talked about using it in two places at one time, but you're creating a legacy. And that came to me when I was sitting down with our estate planning attorney several years ago. And we were talking about the limits on estates and the taxable limit. And he's like, oh yeah, you have to start planning because your estate's worth this much. And I was like, that's not, I was like, where'd you come up with that number? He's like, well, he's like, this is your life insurance and your real estate. And I was like, my life insurance? He goes, yeah, your net worth includes your life insurance. And when I was sitting down with the estate planning attorney, he was looking at it as my family's net worth, not me. So if you're not thinking about life insurance and you're not thinking about the next generation, it's very selfish in my opinion. Just like asking my friend, like, well, what's your rate of return on your life insurance policy when your wife died? Like, that's not how he thinks about it. It's a very selfless way of thinking because you're thinking forward and about another generation. So I think as I've learned these things and I see these things, I've also tried to figure out, how can I look forward and do these? And it's a way that what's interesting is you can create that generational wealth and you actually don't have to take anything away from the strategy that you are currently using today.
So powerful. Thank you so much for sharing. Guys, I thank you so much for joining us tonight. This has been amazing. Benny said, great session. Thanks. You guys make sure to reach out to Chris if you guys are interested in pursuing the strategy further and want to talk about your personal situation and how this might apply. We're going to do like a quick little wrap up with everybody. Blake and Chris, if you guys need to drop, thank you again for joining. Guys, don't go anywhere yet because I have two questions for you before you guys head off for the night. Hang in there.
Wendy, thanks, you.
Wendy.
Appreciate it. Thanks everyone for your time. Let us know if you have any questions.
Yeah. Guys, thank you so much for taking your most valuable resource, which is your time, and spending it today, tonight, learning about all these different strategies. What would help me moving forward is for you guys to go to the chat box or wherever you feel comfortable, go in the Q&A box. Let me know what you enjoyed about tonight's boot camp, what we can improve on for future boot camps. Again, I do these sessions not for me, but for you. And so, yes, your feedback is critical for me, like crafting the next boot camp and what you guys might want to hear. So if you would, before you take off, before you close down Zoom, just take a couple minutes in the chat box, Q&A box, or even email me directly and let me know what you liked and how I can provide more value to you. And if you got any additional questions, drop them in the chat box about tonight's presenters, and I'd be happy to try to field what I can. All right, guys, I haven't gotten, oh, awesome, Betty, thank you so much. Awesome. Yeah, that's great feedback. Thank you so much, Benny. Any other feedback from you guys? It'd be super, super welcome. Benny said lots of great info, cons, significant time investment. Hopefully what I was able to do is collapse time for you guys, right? How often have you taken, it might take me like a week or 2 or 3 or 4, like to figure out like, what do I need to do legally or tax wise, or, how do I invest with my IRA account? I realized tonight was a big investment. Thank you so much for investing in yourself. Hopefully after tonight, you feel well empowered to take the next step to investing. Let's see. Yeah, I even learned a few things tonight. I gotta reach out to my CPA about the 990T. So that's what I learned tonight. All right, guys. If you're still, I'll hang out here for another minute to see who's still typing in some feedback. Again, feedback is hugely grateful for me to be able to craft the right programs for you. If not, I will see you next week on the Tuesday masterclass. Take care.